Ladies and gentlemen, before we begin this event, allow me to inform you several guidelines during this session. First, you may type your question via Q&A feature with format, name, followed by your institution name, also the speakers whom your question delivered to, and followed with your questions. All of your questions can be submitted both in English and Bahasa. And also, we provide interpreter feature. Please choose the language that you most comfortable with. Thank you and hope you enjoy discussions today.
OJK memiliki visi dan komitmen yang kuat dalam pengembangan sumber daya manusia sektor jasa keuangan secara berkelanjutan, guna mendukung terwujudnya industri jasa keuangan yang stabil, kontributif, dan inklusif. Kami sadar, dalam mewujudkan visi tersebut, peran SDM yang unggul dan kompeten menjadi kunci utama. OJK Institute hadir untuk menjadi Center of Excellence, guna mendukung pengembangan sumber daya manusia sektor jasa keuangan dan melakukan riset-riset yang inovatif dan terkini. Pengembangan sumber daya manusia sektor jasa keuangan yang kompeten dan profesional menjadi salah satu faktor penting dalam mendukung keberhasilan kinerja lembaga jasa keuangan. OJK Institute memiliki 3 fungsi utama. 1. Mengembangkan kapasitas SDM sektor jasa keuangan melalui penyelenggaraan program pelatihan, seminar, dan workshop. 2. Melakukan riset yang inovatif dan visioner. 3. Merancang dan mengembangkan standar kompetensi SDM sektor jasa keuangan, serta melakukan penata laksanaan lembaga sertifikasi profesi. Dalam rangka meningkatkan kompetensi SDM di sektor jasa keuangan, OJK Institute menyelenggarakan berbagai program capacity building, baik dalam bentuk workshop ataupun webinar. Menghadirkan narasumber terbaik yang memiliki keahlian di bidangnya, antara lain bidang perbankan, pasar modal, IKNB, teknologi digital, dan lain-lain. Riset di OJK Institute berbasis akademik dengan memperhatikan perkembangan terkini. Penyusunan riset menghasilkan temuan dan rekomendasi yang mendukung kinerja sektor jasa keuangan. OJK Institute juga menyediakan perpustakaan digital e-library OJK yang mengelola koleksi buku digital, koleksi internal OJK, koleksi buku fisik, dan koleksi e-resources mitra OJK. Selain itu, manfaatkan juga aplikasi Elip OJK untuk membaca e-book melalui smartphone. Minisite OJK Institute tersedia sebagai portal media digital untuk mempermudah publik mengakses berbagai informasi kegiatan OJK Institute terkini. Selain itu, OJK Institute juga membangun knowledge management system sebagai media pembelajaran dan pertukaran knowledge secara digital yang dapat diakses oleh seluruh SDM sektor jasa keuangan. Indonesia saat ini telah menerapkan strategi pengembangan SDM berbasis kompetensi. OJK Institute bekerja sama dengan instansi-instansi terkait dalam menyusun suatu standarisasi kompetensi yang disebut dengan SKKMI, yang kemudian diturunkan menjadi KKMI. SKKMI dan KKMI dimaksud digunakan oleh lembaga sertifikasi profesi atau LSP dalam penyusunan skema sertifikasi, pengajuan rekomendasi, dan pengajuan pendaftaran ke OJK. Selain 3 fungsi utama tersebut, OJK Institute juga berfungsi sebagai license officer, praktek kerja lapangan, visit OJK, penelitian mahasiswa. OJK Institute memfasilitasi program praktek kerja lapangan di lingkungan OJK bagi pelajar dan mahasiswa. OJK Institute juga menerima kunjungan lembaga pendidikan yang ingin memperluas wawasan bidang tugas dan fungsi OJK serta sektor jasa keuangan. Selain itu, OJK Institute senantiasa memfasilitasi mahasiswa dalam hal penyediaan data atau informasi terkait dengan tugas dan fungsi OJK. Dalam rangka mendukung pengembangan SDM sektor jasa keuangan, OJK telah menerbitkan Cetak Biru Pengembangan Sumber Daya Manusia Sektor Jasa Keuangan 2021-2025 pada 25 Mei 2021. Cetak Biru tersebut memiliki visi, yaitu mewujudkan SDM sektor jasa keuangan yang profesional, berintegritas, dan berdaya saing global dalam rangka meningkatkan kinerja sektor jasa keuangan. Visi tersebut dijabarkan dalam 4 pilar misi, yaitu 1. Mengembangkan standarisasi kompetensi SDM. 2. Mengembangkan metode peningkatan kompetensi SDM. 3. Mengembangkan infrastruktur pendukung pengembangan SDM. 4. Mengembangkan SDM yang memiliki kompetensi digital. Implementasi Cetak Biru ini kemudian dituangkan ke dalam 21 program kerja yang akan dilakukan dalam kurun waktu 5 tahun dengan melibatkan peran aktif dari industri, akademisi, OJK, dan lembaga lainnya. OJK Institute memiliki komitmen yang kuat untuk melaksanakan Cetak Biru tersebut bersama-sama dengan pengawas, industri, akademisi, dan pemangku kepentingan lainnya. Cetak Biru tersebut diharapkan menjadi kerangka acuan dalam mendukung pengembangan SDM sektor jasa keuangan. OJK Institute, Center of Excellence.
Yeah, ladies and gentlemen, we invite you to sing our national anthem, Indonesia Raya. Please adjust your camera and be arise. You may now be seated. Assalamualaikum warahmatullahi wabarakatuh. Good afternoon. Salam sejahtera, Om Swastiastu, Namo Buddhaya, Salam Kebajikan. The Honorable Chairman of Board of Commissioners of the Financial Services Authority, or OJK, Bapak Mahendra Siregar, Faculty member of the London Institute of Banking and Finance Center of Digital Banking and Finance, Mr. Jeremy Larsen. Managing Director Asia Pacific Thought Machine, Mr. Nick Wild. Partner Oliver Wyman Firm, Mr. Dan Jones. LIBF guest speaker, Ms. Katskili, Head of OJK Institute, Bapak Agus Sugiarto. Director Financial Services Sector Development, Bapak Hikmah Rinaldi. Executive Senior Analyst of OJK Institute, Ibu Ninyoman Puspani. Leaders and Employee of OJK. Leaders of Financial Services Industry, Financial Services Industry Association representatives, distinguished guests, ladies and gentlemen. Welcome to the How to Measure Successful Digital Financial Services Return on Digital Investment webinar today, Thursday, 4th August 2022. Thank you for your enthusiasm. We record that there are 2,320 people who joined this webinar today. The majority comes from the government institution on 7.6%, academy 7.11%, the banking sector 43.15%, and the non-bank financial industry 19.53%, the capital market sector 6.47%, OJK 6.38%, and others 9.31%. Thank you very much for your enthusiasm, and we're really pleased to welcome you to this webinar. Ladies and gentlemen, before we begin, allow me to deliver a short brief about our agenda today. Our event will be opened by the opening remarks by Chairman of Board of Commissioners of the Financial Services Authority, or OJK, followed by presentations and discussions led by the moderator, which will be me, and also followed by question and answer sessions before we close our webinar with the closing statements from our panelists. Distinguished guests, ladies and gentlemen, we are now opening today's event with the welcoming remarks by the Chairman of Board Commissioner of the Financial Services Authority, or OJK. Please welcome Mr. Mahendra Siregar.
Distinguished speakers, Mr. Jeremy Larsen, Associate Director, London Institute of Banking and Finance, Mr. Nick Wild, Mr. Dan Jones, Ms. Katskili, all representatives from Financial Services Industry and Association, ladies and gentlemen, all participants. First of all, I would like to thank the London Institute of Banking and Finance for the collaboration to host today's seminar. Appreciation also goes to all speakers who have dedicated time and efforts to share some knowledge and insight with us. As we are all aware, the COVID-19 pandemic highlighted the rapid advances in digital transformation that redefining our world in every aspect of business, industry, and society. This transformation represents an immense opportunity to create value for both industry and society by leveraging technology to generate sustainability. Technology is the multiplier that provides the industry with great opportunities for value creation by transforming customer relations and expectations and how the industry can address them. In the financial services industry alone, digital financial services bridge the financial inclusion gap by reaching people in rural and remote areas, as well as low-income population and MSMEs. Technology brings financial products and services closer to the people, hence increasing their economic opportunities and improving their lives. We can certainly say that the digital transformation helps achieve the SDGs by making the world more inclusive and prosperous. Distinguished speakers, participants, OJK strongly supports the development of innovation in one integrated digital financial ecosystem. Financial service institutions in Indonesia are encouraged to be relevant and responsive to consumer needs and technological developments to support financial inclusion and create financial sector stability. OJK's policies encourage digital transformation in the financial services sector, which focuses on the implementation of fast and massive digital transformation in the financial services to create agile, adaptive, and competitive financial service institutions. In addition, OJK also issues regulations that accommodate innovation to ensure a level playing field among the financial industry while prioritizing consumer protection and the development of inclusive digital financial services that focus on empowering MSMEs. While technology provides opportunities for financial services and consumers, it also presents risks and challenges for financial institutions. In this matter, financial regulators provide an advanced and efficient tool to address the risks related to digital financial services by maximizing regulatory compliance and surveillance. In this context, I believe the role of supervisory technology and regulatory technology are indeed significant for both the regulators and also the financial industry to improve surveillance and analytical capabilities, which generate real-time indicators of risk to support forward-looking supervision and policymaking. The digital transformation must also pay attention to the development of digital talent by changing the orientation from previously unskilled labor to more analytical skilled labor. Distinguished speakers, dear participants, to measure the effectiveness of digital transformation, it is important to determine the key performance indicators of successful digital transformation. There are several measurements for digital transformation, such as productivity, amount of revenues resulting from digitalization, processing time of delivery of goods and services, number of new customers, and return on investment. It is important to highlight that digital transformation initiatives will help employees be more productive. Related to that, introducing new digital technology also means increasing revenue in relation to new technologies and enhancing customer engagement to see if the consumer is connecting with digital financial products and services. However, the financial services industry should not look for financial benefit or revenue as the ultimate goal of digital transformation, but also to develop more sustainable financial services and products that support the continuity of the business. Ultimately, the digital transformation needs to focus on building greater financial inclusion that will increase job creation and bring prosperity globally to mitigate income inequality and climate change concerns. Building a strong digital transformation, ladies and gentlemen, distinguished speakers, is most effective when there is a collective effort involving multiple stakeholders and the boards of the companies. Thus, a concerted effort is needed to enhance the implementation of digital transformation in the financial industry while mitigating the risk that entails. I'm confident that we can achieve the desired outcomes and goals if we work together. I hope this webinar will provide clear and comprehensive input for our digital transformation effort, as well as maintaining competitiveness and generate sustainable growth. And finally, I hope today's discussion will be fruitful and give a huge contribution. Thank you very much.
All right, thank you very much, Bapak Mahendra Siregar, Chairman of Board of Commissioner of OJK, for your such a warm welcome and also insightful key points that I ensure indeed will be answered by our panelists today. And due to attending another agenda, Mr. Mahendra Siregar, you may now leave the virtual room. And once again, thank you for gracing us with your attendance today. Distinguished guests, ladies and gentlemen, we have come to our main session. There will be question and answer session after the presentations of our panelists. And for that, you can type your questions via Q&A feature by input your name, followed by your institution name, the speaker's name, and also your questions. And once again, I remind you that all of your questions can be submitted both in Bahasa or in English. And at the end of our session, we will have the feedback form that you need to fulfill before the Friday, 5th of August, as the requirements to get the e-certificate. Yep, ladies and gentlemen, we would also like to inform you that we have the interpreter features that you can use. So if you comfortable with Bahasa, you can just listen it by the interpreter features. And we would like to invite our first speaker for today's event, the faculty member of the London Institute of Banking and Finance Center of Digital Banking and Finance, Mr. Jeremy Larsen. He is currently MD of Strategy Consultancy of GrowSmart. Mr. Jeremy has a long background in strategy, product, and general management across fintech, as well as banking and insurance incumbents. Previously, UK GM and Global Partnerships Director for Currency Fair, Mr. Jeremy was also the founder GM of Telegraph Financial Services and co-founder of John Lewis Finance, as well as Global Head of SME Innovation for RBS Group. Jeremy acts as a mentor at 4 fintech accelerators and has advised well-known startups such as Yolt, Genuine Impact, Tide, and also Kuva. He has an MBA with distinction from London Business School and an advisory board member and net of 2 fintechs. Ladies and gentlemen, please welcome Mr. Jeremy Larsen.
Thank you very much for that warm welcome. And I particularly want to pay gratitude to the chairman's opening remarks, which were thoughtful, kind, informative, and set a great platform for the rest of the discussions that we're going to get involved in today. And let me first say what a great privilege and honor it is to be presenting at the OKJ's webinar. You may recall, many of you may recall that I gave the keynote approximately 12 months ago on embedded finance and open banking and banking as a service to the same audience last year. So it's a huge privilege that you enjoyed that so much that you invited me to come back again to present today on what makes a successful digital transformation and how to measure it. And before I start my presentation, I also want to acknowledge and pay tribute, and I'm very much looking forward to sharing the floor with Nick Wild, who's the MD at Thought Machine, and also Dan Jones, who's the partner at Oliver Wyman, discussing all of these topics today. And lastly, I am going to be introducing my dear friend and colleague, Kat Kiley, who is a leader in terms of digital transformation, growth, and change. And she's going to have some very interesting insights about some of the factors to take into consideration from a people and talent and culture dimension in relation to digital transformation. So very much looking forward to hearing what she has to say as well. But without further ado, let me share my presentation and get the ball rolling. So today's presentation is around successful digital transformation and ROI. And in particular, it's about how does one create competitive advantage via digital excellence, effective evaluation, and responsible management of digital transformation initiatives. So today's agenda, digital transformation. What does it mean and what scope does it encompass? What do banks, fintechs, and banking as a service seek to gain advantage with transformation? Setting up digital transformation the right way for your business, bank, or fintech, aligning strategic objectives and culture to achieve maximum results. Then the main event, we're going to be really talking about the metrics of digital transformation return on investment. In particular, we're going to measure and evaluate customer experience initiatives, operational efficiencies. Have you identified what the opportunities are from digital transformation? What are the benefits and or the savings? Ongoing KPIs. Once your solution has been launched, what are the business as usual metrics which you need to apply to your digital transformation to understand whether it's been a success? And then lastly, we're going to look at some key success stories across the world of banking and fintech who are real digital transformation exemplars. Who are the world's best digital banks and what's their approach to transformation? And then lastly, we're going to look more further in on ourselves and see and consider, how do we evaluate the right digital transformation strategy and approach for your organization? I'm going to start with one of the great luminaries in tech, of course, Steve Jobs. The erstwhile Steve Jobs had a fantastic quote at the advent of the smartphone in Q3 2007, when he said, "Banks are literally museums of technology. We're at the cusp of a revolution in customer experience, and banks will be wiped out if they can't see the tsunami happening in front of their own eyes." Now, that was right at the point that the first ever smartphone was introduced. I think those are somewhat apocalyptic words and haven't actually been borne out in reality, though there were many banks that didn't heed those words and actually were playing a big catch-up game right until the last few years. So I just think it's an interesting context setter to show that actually way back in 2007, with the advent of the smartphone, even Steve Jobs, who obviously wasn't in the financial services industry, could have the clarity and perspective to see that banks would be threatened if they didn't get hold of the likely changes to digital customer experience and the requirement for digital transformation. So what is that sort of existing banking mindset, or at least right up until the middle of the last decade? So it was pretty much trying to build a faster horse. I love this picture. It shows how Henry T. Ford, when he launched his Model T Ford, got a competitor's car and put a horse in front of it because he said that car couldn't even outstrip his Model T Ford unless it had a horse to pull it forward. So it was a bit of a marketing gimmick by Henry T. Ford, founder of Ford Motor Company, but I think it's a fantastic photograph. So traditional banking strategy held that the path to success was in improving cost efficiency. Digital was seen as a lower cost channel to service customers more efficiently or push products out faster. It was all about improving the speed and efficiency of core banking and back office systems to reduce operational costs. It was about re-engineering processes and products to make them faster, cheaper, and more efficient. The organizational structures that were put in place, and this was very much popularized by Arthur P. Sloan at General Motors, so immediately after the Ford Motor Company, having a command and control organizational structure, which is pretty much taken on wholesale by the entire global banking industry to manage functional roles consistently and repetitively. And large IT bureaucracies and program offices sprung up to manage significant dependencies and overlaps between multiple legacy systems. I mean, this wasn't exactly a nimble or an agile way to transform their business, was it? So what were those legacy issues? It was more a raging fire than a burning platform. So often for those incumbents, some of those legacy issues included, and I'm going to be very interested to hear Nick's perspective in particular from Thought Machine, because obviously Thought Machine are a global leader in core banking platforms as a service. So I'm really looking forward and excited to hearing his perspective. But many banks up until recently had siloed core product systems and fragmented data models. Organizational models were largely vertically integrated value chains, obviously massively under threat from open banking. New channel and product applications were leading to technology-driven silos. Inflexible and non-modular core systems inhibited integration with other third parties. On-premise infrastructure remained a norm, constraining application change and hindering efforts to combat cybercrime threats. Real-time processing was only being realized sporadically and not bank-wide, preventing in-moment decisions expected by customers and limiting what's called next best action initiatives, where you are served as a customer or a client what the right product is at the right time. And of course, those incumbents until very recently weren't able to exploit the open banking and open finance opportunity. And ultimately, banks were losing the war for talent versus fintechs and big tech firms who had not just more productive environments in which to create and be innovative, but actually they were the fintechs and the big tech firms were the cutting edge and bleeding edge of innovation. So many banks were uncertain as to how to compete and lacked that digital mindset and skills to be able to compete. So what is digital transformation? What is the scope of it? What does it encompass? So I'm going to go through, this is my actual model. This is my proprietary model, but I hope you'll agree that it's a good way to think about the scope and the spectrum of digital transformation. Well, ultimately, it starts with strategy and being able to be clear about what objectives and goals and potentially what vision are you looking to take your bank, fintech, or other service provider by having digital transformation. Secondly, and we're going to go into quite a bit of detail on this, is on data. So many digital transformations that haven't succeeded start right at the beginning in terms of what are some of those seeds of failure that have been sown. And much of that has been not having the right data infrastructure to facilitate an effective digital transformation across a number of different data silos. Third, and this is my particular specialism with strategy around customer experience. So clearly, as I've mentioned, big tech and fintechs and other service providers in the banking as a service space have led on customer experience. And clearly, if back-end systems and data are not forthcoming in a way to be able to refresh dynamically the customer experience, then a bank is at a real competitive disadvantage. So we're going to talk quite a lot about digital transformation from a customer experience perspective. Fourth is around what are those core banking systems, those tech and operational platforms that underpin all of this. Fifth, as an opportunity, we've talked both, or rather we've heard in the chairman's comments around how digital transformation provides an opportunity for ecosystem development and creating potentially new propositions and new business models. And then lastly, of course, very key point, which Katz is going to really drill down on around what is the culture that you need to cultivate in your bank or indeed fintech for digital transformation to be effective. And how do you grow the people within so that they become digital transformation exemplars themselves? Now, these 6 components, in my opinion, are the bedrock of digital transformation. Yet there are 2 very important components that both, if you like, belt and brace it, make sure that the digital transformation happens effectively to your strategy and to your vision, and that you're able to assess the return on investment significantly. So one is obviously around metrics, having the right metrics from the get-go, from the strategy time in terms of understanding what the business case, what are your both commercial metrics, but also what are some of your customer experience and operational metrics, and potentially how is that shifting your brand? So all of that has to go within a metrics layer across each of those 6 different areas of digital transformation. And then lastly, what I'm calling a digital maturity model. So at what point do you have to reach in each of these 6 particular components of transformation in order to get to where you want to achieve from digital transformation. So you need to have a sort of clear sight and clear perspective as to where you are today, where you want to be tomorrow, and more importantly, where do you want to be in 24 months' time as well. So those are the 6 core components of digital transformation, and underpinned and backed up by the digital maturity model and the underpinning metrics which assess for return on investment. So let's talk about that first component. Strategy. Well, today, strategy very much equates to digital strategy. So the vision of digital needs to be, and for the most successful banks that have undertaken transformation, and we've got some great case studies later, the vision of digital is at the core of a bank's reason to be. You know, that's why they're in business, because they are providing digital financial services at the point of need to a range of target client and customer segments. It's reframing where to play in the new value chain. And what I mean by that is, obviously, with the advent of open banking, the creation of an API economy, what's happened is, of course, the traditional vertically integrated value chain, which was dominated by banks. So a bank would essentially be responsible for everything from the back end to the middle office to all the core banking products, right through to the customer experience there. That was all a vertically integrated value chain. Obviously, with open banking and open APIs, what that has enabled is the rise of banking as a service. And many different actors and third parties are now legally able to play at different points in that traditional financial services value chain. So it's a new value chain underpinned by regulation, as in Singapore with the Monetary Authority of Singapore, in Indonesia as well as in the UK and Australia. And that sort of original UK open banking model, which was first implemented in 2017, and the banks had to conform by the 1st of January 2018, is now a model that is popularly being replicated across the world, particularly as we're seeing right now across the Middle East as well. So the digital strategy is about, where does a bank want to play in the new value chain, in a fragmented, in a unbundled and now a rebundled value chain. It's about seizing those opportunities in open banking and open finance. It's about creating a vision and mission which inspires employees and customers alike. And I want to talk about one particular case study towards the end, and it's around DBS, so the largest bank in Singapore. It is generally accepted that that is the sort of the template for successful digital transformation. And the culture change aspect there was very much part of the strategy up front, which was to, as they put it, to make banking joyful. Let's talk about that second core component, data, and what are the right data infrastructures that are required in order for digital transformation to be truly successful. So the principle around this is around being able to exploit that digitization of information. The fact that now everything, whether it's transaction data, customer profile data, or related non-financial services data that can be included in, for example, credit scoring models, it's being able to have flexible and scalable and proactive data infrastructures which are rich with analytics, which can provide that personalization layer. So it's about bringing together multiple internal and external data points and exploiting different customer context to create those in-moment customer decisions. It's about using open banking to create true single customer view capabilities. And by that, I mean not just being able to provide a single view of a customer's product holdings and transaction levels and quantum of different products within the one bank, even though for many banks, actually getting a single view of a customer's relationship with one single bank has been proved very problematic given all the technology and data silos that banks have had. But this is about not just getting one bank together, it's about getting the entirety of the jurisdiction landscape. Obviously in England, which was the first, or rather the UK, which was the first jurisdiction to launch open banking, there are now more than 3,000 third-party providers who are either what's called AISPs, Account Information Service Providers, or PISPs, Payment Initiation Service Providers. And each of those has an ability to access the existing banking consumer profile data as well as transaction data. So what you need to create is the right data infrastructure, create a true single customer view across your own bank and the entire financial services industry. It's about exploiting machine learning, artificial intelligence, open banking, and open APIs, create dynamic propositions and pricing. And of course, if you get the data element right and the data infrastructure, data quality and accuracy significantly reduces credit and operational risk and improves return on assets. So I want to talk about the customer experience layer and winning the battle for customer engagement. So why is it so important to provide incredible experiences and service? Well, it does provide a sustainable long-term competitive advantage across the following areas. So if you win the battle for customer engagement, of course, right at the top, you have much higher customer acquisition than your competitors. You have higher usage of those products that customers have bought into, higher volumes. You have higher customer satisfaction and advocacy. You have, on the bottom right-hand corner, you have lower marketing costs. It's cheaper to acquire those customers if you're renowned as a great customer experience. You have an attractive interface. It compels customers to be drawn into your funnel as a bank or a fintech, and then to use that platform and then to engage with it and actually transact to buy a product from you. You're winning the battle in terms of brand as well. So those companies that have a better customer experience and a more talked about, an experience which cultivates greater advocacy, have stronger brands, they're more resilient, and generally speaking, you'll be able to charge a higher margin as well. You're going to win that battle for customer retention as well. So it's less likely if you have a fantastic customer experience, which is personalized, which is able to react in a very responsive way, depending on sort of in-moment decisions that are required, you're much likelier to keep that customer or client than your competitor. What all of that ultimately means in terms of customer acquisition, higher product usage, greater customer advocacy, lower costs to acquire and to retain customers, is you're going to have a higher market share as well, which ultimately is going to lead to the main prize, ultimately, for your shareholders, which is market capitalization and the value of your bank. And it's very interesting. We talk about market capitalization in a sort of glib way, but it's absolutely not glib or insignificant. In fact, research done by BCG and McKinsey that was published only a couple of months ago in May, there was a joint study in terms of the impact of digital transformation and what is the likely impact on banks versus fintechs. And they asserted that fintechs are likely to get a 4 times greater benefit by implementing digital transformation successfully. So it's really incumbent upon the banks, the existing financial services industry, to get digital transformation right so it doesn't have a value migration in terms of its market capitalization going on to fintechs. This is not a small matter. This is almost life and death for the bank. So incredibly important to get that customer engagement right. So this is a model that I've created. I call it the 4 Ps of digital customer experience, a little bit like the marketing 4 Ps, except I've repurposed that for digital customer experience. So my 4 are product, price, personalization, and place. So in terms of the digital customer experience, you need to think of all of these 4 elements as well as brand in terms of how do you create the right customer experience, which not just improves acquisition, but generates far greater interaction, product usage, and advocacy. So in terms of the product, what are the functional benefits which add value or make my life easier? In terms of price, does your customer experience facilitate a way to get the right price and the right rate matched to my risk, loyalty, and value? So how can that pricing be dynamic to take into account your own particular circumstances or a business, an SME's own particular circumstances? As well as, are there any reward offerings potentially that can be dynamic as part of your customer experience as a way to attract both acquisition, but also to increase usage and advocacy? So that's all part of the pricing mix. So not just the cost and the rate and the price, but also the rewards element. Thirdly, personalization. Is that product, price, marketing tailored to my needs and preferences? This is where that concept of next best action comes in, where those that have really cracked digital customer experience well are able to serve the right offer at the right time in the right channel. And in terms of personalization, do I feel good and am I cared for by the experience that I'm receiving? Is this an experience that is, in effect, joyful, as DBS said, making banking joyful? And then lastly, the actual experience layer itself, or rather place. Is the experience easy, clear, and seamless? Is it available in the channel I need, or is it omni-channel? And of course, very importantly, is it responsive? And that's very much where Steve Jobs was thinking about way back in 2007 with the first ever smartphone, because he saw pretty much across the entire financial service industry back then that journeys, experiences were not responsive, which is, you know, his wake-up cry to the whole of the financial services industry. And then this is an important area. So this is that 4th component, which is around the core technologies. And again, as I said, I'm really going to enjoy hearing from Thought Machine in terms of their perspective. But we've covered so far strategy, we've covered data, we've covered customer experience. The 4th area is around the tech and ops operational infrastructure. So up until 2017, the norm for banks was to ensure that their core systems, technology, and data stores was fit for purpose via a process of renovation. That was the term used to ensure the upgrading of their core systems. It was an incremental approach prioritized by business unit, which minimized risk and ensured regulatory compliance. As I've talked about with the advent, the creation, and the implementation across the whole financial services industry of open banking and the development of an open API economy and that fragmentation of traditional financial services value chains, it's imperative for banks to decide where it wants to compete in that value chain and create a tech capability which enables access to data and third-party applications. I mean, that's the single biggest imperative, and that's what that graphic is related to on the right-hand side. Banks need to create modular API platforms and have that ability interface effectively, seamlessly, and responsively with third-party applications. And as I already previewed, there are some great case studies about certain banks that have done that. The most successful digital banks, e.g. DBS in Singapore, BBVA in Spain, across continental Europe, and most importantly, across the whole of Latin America, and Starling in the UK, have created flexible modular tech stacks and data stores over the cloud, which have facilitated API platforms application programming interface, that's what API stands for, to be built which access and distribute data over a global network. Crucially, these API platforms are open source and leverage plug-and-play technologies. Partnerships can happen quickly, and in-house and third-party applications can be tailored to different audiences. So, a crucial fourth component of digital transformation. I just wanted to talk about BBVA. This was a abstraction of their very successful BBVA open platform. That's what it's called, BBVA open platform. It's a very significant SBU or business unit of BBVA. It powers more than 100 banks across continental Europe and fintechs in Latin America with its sort of banking as a service or banking as a platform capability across all the range of banking APIs required, including renting out its license. And it has structured its API platform in the following concentric circles. So right in the heart is an API platform which is used by developers between different businesses across the BBVA enterprise. So that's the red innermost circle. And what that leads to is greater operational efficiency, enhanced security across the entire banking enterprise, as well as obviously cost reduction. The second, the light blue concentric circle, is the API platform which interfaces with all of the third parties that it has relationships with. So this is both for platform banking. Platform banking is the expression where BBVA or a bank insources different third-party applications and then remarkets them seamlessly through its own interface. Or it could be service banking, another word for embedded finance, where BBVA, in terms of its APIs, power the applications of a number of different third-party fintechs and banks. So that concentric circle, the blue one, that's the APIs used by business partners, including suppliers, providers, resellers, and others for tighter partner integration. And the attributes you get from that are enhanced security, of course, monetizing those APIs. So BBVA Open Platform made 900 million euros in revenues last year, as well as reduced partner costs. And then lastly, of course, their API capability has a public role to play as well, both used by external partners and developers, as well as regulators to be able to look at some of the applications that BBVA are running and sort of check under the hood and see that the models that they have are not biased in any way. So what are some of those attributes? So innovation through engaging developer community and extended market reach. BBVA really created the template for that. What's very interesting is they were the first big bank to make that decision way back in 2015 to create BBVA Open Platform. And what's interesting is that a number of other banks have followed, namely Nordea in Scandinavia, in Sweden, has also created its own banking as a platform capability, and a number of different fintech who are in the banking as a service space also play in that space, notably Solaris Bank. Would be great to hear what Thought Machine say on this as well. Let me talk another aspect of those core technologies. So the potential for cloud to drive transformation is very significant as well. So cloud is used very much to help facilitate back-end core processes, as well as the customer experience as well. So on the back-end core processes, so core banking as a service on the cloud, the Thought Machine there, and Mambu, neobank architecture, all the core banking processes stitched together. Starling do this, not just for themselves, but for other third parties as well. Chime, which is really interesting, the largest US neobank or alternative bank, has 22 million customers in the US, and they are very proud of the fact that not a single part of their operation, except for their artificial intelligence layer, which helps in the decision making in terms of what to serve to customers is owned by them. That's the only bit that they actually own and create. All the rest, whether it's financial products and services, whether it's core banking, whether it's some of the key banking components such as KYC and authentication, all of those are stitched together from external third parties. Really interesting study at Chime. Cloud also facilitates computing scalability and capacity. Core administrative functions such as HR and finance can now actually be served very successfully over the cloud, as well as improving cybersecurity and business continuity. And in terms of the customer experience, how can cloud facilitate great efficiencies and transformation there? Well, in the UK, Revolut and NatWest, one very successful neobank and super app, and NatWest, one of the 5 largest high street banks in the UK, use AI-driven automated chatbots, which continuously improve. There are contact center virtual desktops that are provided over the cloud. Notably, ING's is considered a market leader by Forrester. Personalized banking mobile dashboards integrating third-party products, for example, Chime, as we've mentioned, and Yolt. Personalized experiences via advanced voice recognition and routing, Chime. And then, of course, verification and one-time passcode APIs for in-app experience, such as Wise and Stripe have created, if you like, a one-time passcode as a service capability, which it offers a number of its clients as well. So those are just a handful of some of the ways that cloud is powering great transformation in back-end core processes and customer experience. I'm quickly going to go, I wouldn't be a consultant if I didn't have a 2x2. And what I think is helpful about this particular slide, which I'll go through quickly, is to show that there are a range of different strategies that are being played by challengers versus incumbents. So banks that obviously represent the traditional banking industry and how they use cloud to play in different spaces. So I'm going to talk about the bottom left quadrant first. So this is the likes of BBVA for its own operations, NatWest and Barclays, a lot of investment there, relationships as well with many of those core banking as a service providers that we've mentioned, who are thinking about cloud in order to improve their scalability and consistency across different markets and, to create that joined up view, but also principally for cost efficiency. We're looking at a range of incumbent banks in the top left-hand quadrant, where cloud is enabling what I'm calling platform banking, which is where the bank insources third-party products and applications and integrates that seamlessly within that experience for use by their customers. So both challengers and incumbents, but principally a lot of the challengers are looking at cloud to help improve their back end to create the capability for platform banking, to be able to accept external third-party applications and new products. If you have a look at the bottom left-hand quadrant now, so here is on the axis customer experience, horizontal, and this is incumbents on the vertical axis. So we're looking at, the likes of HSBC, DBS, and you'll notice BBVA as well. So not just BBVA, the bank, which has been in the other two quadrants, but BBVA Open Platform. This is their banking as a platform, very large business as well, see cloud as an opportunity to create new business models and marketplaces. And then lastly, there's a range of both big tech companies such as Google and Amazon. Google have achieved a nationwide US banking license as of March this year. Amazon have made more than 33 fintech acquisitions since 2020 globally, mainly to help facilitate their supply chain with a range of different suppliers in countries such as China, India, etc. So really to speed up the the cycle time in terms of when suppliers get their money, but also to create bespoke payment propositions, Amazon, in countries like Mexico. So Amazon, as well as the likes of Chime, Adyen, Stripe, Revolut, see cloud as an opportunity to get involved in embedded finance, to be able to provide their banking products to other third parties. Embedded finance, another term for embedded finance is service banking, as well as to play in adjacent markets seamlessly. So using cloud properly has a range of different strategies and capabilities that incumbents can really seriously look at to both accelerate their transformation, but to take themselves into potentially new business models as well. So I hope you found that interesting. This is a model I created myself. This is a slide actually taken from Accenture. I have to give them credit. So the fifth element in digital transformation, in my view, is around ecosystem and new business development said, echoing the opening words from the chairman today. So digital transformation can absolutely lead and should lead to the creation of not just new propositions, but potentially a bank being at the center of creating a significant ecosystem, again, facilitated by open banking and open APIs, as well as complementary technologies such as artificial intelligence. So building the ability to build ecosystems once you've got that digital transformation capability really differentiates the leaders from the also-rans. So here there is a scale to say, depending on the size, market and strengths, the approaches that a banking incumbent can embrace could include any one or a mix of the following. So from the left-hand side, vertically integrated models through to non-linear models. So models which are all about playing opportunistically and strategically in different parts of the financial services value chain. So on the one hand, part of that new business development and ecosystem development could be using digital transformation to improve the process of the traditional value chain. So controlling all the layers in the value chain from manufacturing up to distribution in a model of vertical integration. That is a classic traditional financial services value chain. And many banks have still pursued a route. I'm not saying it's wrong. Each bank has to assess for itself what the right strategy is. But a number of banks have chosen to employ digital transformation to improve their existing value chain. Second way is to build a distribution-driven ecosystem. So being able to distribute banking and other financial products from other companies. In other words, what's called platform banking, and distributing non-banking products via a marketplace. So DBS's marketplace is one example of that. Another in the UK, and very interestingly, was HSBC and First Direct, which employed the company, the banking as a service provider, BUD, to build a bespoke financial services marketplace for their own UK customers to use at HSBC and at First Direct, a subsidiary of HSBC. Third would be to sell your capability as a service. So seeking scale by having a technology or business process that are invisible to end clients. So this is what I meant by, because of open banking and that fragmentation, the unbundling of the value chain, you now have a host of new fintechs and tech companies fulfilling specific roles in that value chain. Onfido is a fantastic example of KYC that has gone wholesale across the global financial services industry. They're in more than 52 different country markets, and they're the leader for facial recognition KYC. Through to creating new propositions through non-linear business models. So building or putting together fragmented micro products. For example, Grab in Singapore, the super app. Gojek in Indonesia is doing something very similar. as well as building products to be distributed via other companies and embedded into their apps and digital experiences, otherwise known as embedded finance. So there's a whole range of different plays in terms of what model you're looking to benefit from digital transformation. So let's think a little bit about what some of those 6 revenue models are. There's a whole sort of host of a conversation you could have on each one of these, but I'll go through these at a very sort of high level, and would be great for you to think about those. And please reach out to me if you want some help in thinking about what some of those different revenue models might be for new business models. So e-commerce. So, how do you improve your virtual, your mobile, your desktop, potentially other technologies in terms of that commerce engine to drive products and services sales? Are there ways that you could, secondly, apply a subscription or membership model? So that's having recurring revenues for the duration of the relationship that a customer or client has with your business. It's very interesting. In the UK, there are some very successful neobank and fintech subscription models. Plum, which is a auto-changing savings application and spending application, as well as Revolut, have a subscription model. Outfox the Market, which is a leading insurance challenger, is a membership model. Marketplace. So can you develop a marketplace in the same way that BBVA Open Platform has done, or Solaris Bank? So marketplaces earn revenues for facilitating transactions between demand and supply sides, a bit like Uber or Amazon, but in the banking space, BBVA Open Platform is a great success story. Software as a service or licensing, is this something that you could have a proprietary software which you could deliver to businesses and consumers? Premium model. Is there a new target audience that you could reach potentially from digital transformation, a new business model that actually the revenue model is that the core product or service is free, but additional features are served with fee upgrades? And then on demand. So transaction revenues for every completed on demand order. So, obviously this has been a very common revenue model for most of the customer transactional platforms such as Uber and Airbnb. Are there ways that you can, if you like, reduce the financial product or service, a micro product or service, as Accenture said, and charge for that in a cheaper way and serve a wider audience? So that's just 6 different potential revenue models which could be applied to what you devise out of digital transformation, new proposition or new business model. So I'm going to talk about that final, the 6th component of digital transformation, which is around getting the culture right and harnessing the people and talent that you have to live digital transformation. So I want to talk about that gentleman on the right-hand side, a remarkable man. He's been the CEO of DBS, the largest Singapore bank, since 2014, and he's overseen a revolution both in the Singaporean and Southeast Asian banking market, and in particular has seen the market capitalization of DBS climb sevenfold, 700% or 600% since he started. So I will just share what he introduced and his executive team in terms of that culture change. So they launched, if you remember from the strategy side, Making Banking Joyful in 2015, and created a set of values which has set a benchmark for banking and digital transformation culture change. Be digital to the core. Embed yourselves in the customer journey and always think and act like a startup. I mean, these seem highly simplistic phrases, but actually they have significant repercussions in terms of how that particular business, how DBS has organized itself, what it prioritized in terms of most important activities, what it considers to be the key jobs to be done that it focuses on, which bring maximum joy and value to customers. So these have very significant implications in terms of culture and structure and talent management and development. And yes, I urge you to have a look at DBS, specifically if you're interested on that culture change dimension, because what they've done is really legendary in the banking space. So in terms of the product development life cycle, it reduced 75% in 12 months. Their NPS, their net promoter score, so a way in which you're able to assess objectively what the love of the brand is at record levels in the banking industry. The top-rated bank in the United States, for example, isn't a bank, it's Chime, right? It's the neobank, and it has an NPS of 66. So for a traditional bank to have an NPS of 80 is quite incredible. And I just want to talk about what Pierre said. So once people understand what it means to be customer-centric and you give them permission, you unleash this tremendous energy to do things. I love that quote. So let's quickly talk about the culture change in terms of what are those three key components. So once you've taken those principles and values and embedded that into your business, what does that then lead to in terms of different ways of working? So it's about reframing those traditional banking paradigms of maximum stability and minimal change to a world of minimum stability, as you've seen with the unbundling and rebundling of the value chain and new entrants coming in, and maximum change. So there's three core components, in my opinion, that I've seen that separates and sort of clusters the most successful banks at digital transformation. So one is around the digital mindset. Digital mindset equals the customer mindset, a little bit like the strategy side right at the beginning. Strategy equals digital strategy, putting customers at the heart of all decision-making across all business units and all levels. Consider how open banking, and of course, Indonesia is on that path in terms of open banking as well, can be utilized to improve customer outcomes and incorporate new business models and innovation in performance metrics. The second area is about developing, cultivating, bringing into and expanding a fintech network and ecosystem. This is absolutely critical to get that outside in thinking and then be able to influence the working and dynamics of an ecosystem. So looking outside in to learn from successful customer first fintechs, accelerating a network of global accelerators, experts and hubs with connections to leading fintechs, and assessing the potential for new open banking customer experiences facilitated by open APIs for that seamless integration. And then the last key component is what I'm calling a path to productivity, where business teams evaluate and develop new business models and open banking propositions with fintech resources and champions within the bank and outside of the bank. And partnerships with complementary fintechs and local sandboxes, whether they're commercial or regulatory, to test new customer propositions. These are the three core components in terms of what the most successful banks at digital transformation have developed once they've got that sort of cultural strategy outlined, formed, and planned in terms of execution. So what does it mean to create a customer mindset? Well, creating a customer mindset means putting the customer at the heart of every decision the bank makes and how open banking can be utilized to improve customer outcomes. It's about making customers' lives easier, experiences and product features which simplify, speed up, make safer, aggregate or store, or simply make clearer and easier to use. It's about personalization. So it's about using data via open banking proactively, the profile, the needs, the preferences, wants, and behaviors and experiences of customers, tailor products and services which go beyond their expectations. And it's about digital agility and innovation. ensuring all business processes and functions within the fintech or bank can respond quickly to changing customer needs and expectations, and looking out via the bank's open banking ecosystem rather than looking only on the inside. So I want to talk about metrics, because this is the key thing in terms of what you're interested in terms of what to apply when thinking about digital transformation. So metrics are so important because, well, it's the only thing that counts in terms of building a sustainable and significant business. It creates tangibility around a business or digital transformation initiative. You know, what are the revenue streams? What are the operating costs, fixed costs, and all those elements that make up the business case of whatever your digital transformation initiative is. It assesses how economically viable your initiative or proposition is by quantifying and validating your business plan and key assumptions. Is the initiative going to be of sufficient impact and profitability in terms of either reduced costs or greater revenues, that it will be backed by the key decision makers in your bank? It's about getting funded as well. So without the right metrics, you're not going to be able to validate the essential investment factors required by internal investment committees. For example, what's the total profitability, total costs? Is it going to have any impact in terms of the bank's competitiveness, which leads to market share? It establishes a value, if you like, or likely quantum of impact, which provides sufficient investor returns or bank returns or meets the required cost of capital. And it also determines how much funding and capital you actually need to make that digital transformation actually successfully get implemented. And it's very much a segue into that last point. It's about avoiding running out of funds and shutting down. So it's about assessing your runway by measuring your cash flow and burn rate of an initiative, how much time you will have before those funds run out. And an important tool is sensitivity analysis here to test both the revenue model and cost model. How sensitive is your cash flow and profitability if revenues or costs change in different scenarios? What gets measured gets managed. I think that was Henry Ford again, but it's just as vital for digital as for any initiative or any new business case. So this, I think, is one of the most important slides in the whole presentation. If you're going to focus on any one slide in particular, I would say this is the core slide of the whole presentation, because it's showing in terms of what the focus of the digital transformation initiative is, what you're looking to get out of the initiative, what are those core metrics that you need to focus on in both setting up the business case for that initiative, but then being able to evaluate it after that initiative has been implemented. So if it's a new value proposition, a new product or a new service, the objective is about profitability and creating a sustainable and viable new proposition or new model. So some of the things to look out are for market size. What are the customers and revenues? What are the incremental revenues that you can obtain? What are the operating costs, capital costs, customer acquisition cost, customer lifetime value, if this is a revenue generating product or service, ultimately leading into what is that return on investment? For customer experience, which many of your initiatives will be around, given what I've said earlier about the importance of customer experience. So this is about maximizing the volume, value, and appeal of your service for customers and clients. So it's about improving net promoter score. It's about increasing that whole acquisition funnel, increasing activations, registrations, leads, and sales. It's about improving retention and minimizing churn. It's about increasing sales per customer. It's about minimizing what I call the bounce rate. So bounce rate technically means those potential customers or people who are attracted to your service immediately leave your website because there's nothing that's pulling them into that journey. Your experience isn't compelling enough or the content isn't convincing. And it's also about improving that engagement. So how regularly does a potential customer or an actual customer utilize your digital customer experience, whether it's mobile or desktop or another technology? And it's very much about improving that customer service. So there's that feeling that the bank does actually care for me and is responsive. And then that last area, again, probably a critical area for you to be thinking about in terms of transformation, is around operational efficiency. So this is about improving competitiveness, reducing cost, improving quality, increasing productivity and lower cycle time, increasing capabilities where they're needed in those different areas across the bank. And it's improving and expanding the scope of operations as well as lowering risk, which not just lowers defaults and costs as a result of higher risk, it also enables you, for example, to be able to lend more as well, because you'll be getting a better evaluation of customers and a faster processing time to be able to make those credit decisions and disbursements. I'm not going to go through this in tremendous detail, but this is something that I just wanted very quickly to you to all have that familiarity with what some of those key metrics are. So customer lifetime value, this is the revenue that a customer will generate over the lifetime of their relationship. Customer acquisition cost, revenue, churn rate, customer retention, cash flow, net income, burn rate, and ultimately return on investment. It's just a quick inventory. Please take a snapshot of this, but I'm not going to go through this because I think these are probably quite self-evident. So a real consideration at the start in terms of setting up your metrics and key performance indicators are, thinking about, what performance questions are you looking to answer from your digital transformation initiative, which leads to, what KPIs do we actually need? What customer, operational or resourcing or human capital factors do we need to factor in and monitor? Are there leading indicators that we can develop from available data? Can we collect meaningful data in a cost-effective manner for each of the desired measures? Is there a mix of financial and non-financial measures? It's important to get that ROI, but actually part of the ROI is actually assessing, what are some of the other impacts in terms of non-financial? So what is the customer satisfaction like? What is the customer advocacy like? And can existing management information systems, the data infrastructure, support that collection, analysis, reporting, and dissemination, that transfer and spread of data to where it's needed? So, those are some of the sort of real considerations about metrics right at the beginning. Very quickly, I'm going to talk about new propositions. That was one of those 3 columns in terms of the key metrics you need to be thinking about for digital transformation. So the 2 most important key metrics are around customer acquisition cost and customer lifetime value. To measure these 2 metrics, you need average revenue per customer, churn rate, marketing expenses, and number of new customers in a given period. And there's a series of questions there in terms of being able to evaluate what are the likely costs that you're going to put in your model. If you don't have the product, you're obviously not going to have the data. So that's where you need to use benchmark data from comparable companies to find answers to those key questions. Very quickly, you've probably all seen this, but you start in terms of a new proposition by sizing the opportunity, total addressable market, TAM, serviceable addressable market, and serviceable obtainable market. Again, a worked example. This is actually an anonymized live new payment app, but this shows you what the potential market is for a new app, a new payment, a mobile payment app in the UK aimed at SMEs. So this target audience in terms of the serviceable obtainable market was 111,000 small businesses. But when you're doing market sizing, it's critical to triangulate to ensure that you do a bottom-up analysis versus the top-down market sizing TAM, SAM, SOM. So actually, when you did a bottom-up approach, what you saw from these calculations that actually the obtainable market for this particular business, for this particular payments app, was actually 70,000 clients, not 111,000. So very often when you do the market sizing via TAM, SAM, SOM, it often overestimates and inflates the likely market size. I'm going to talk about this very quickly, only because it's a model I'm sure you've seen before. So this was invented by Alex Osterwalder at Strategizer. This is called the business model canvas. It's a way for being able to assess the viability of a new proposition, product or service by focusing on all the core components of whatever that new proposition is. So it's just literally covering, almost like a checklist, what are all of those core components. Customer experience, the second column. So very important, not just to consider the functional metrics, but also the emotional metrics. So some of the functional metrics include activations, registrations, and leads, lead conversion ratio. So how many of those leads actually translate into actual sales, cost per click, cost per acquisition, retention, minimizing churn, sales, volume per customer, bounce rate, product returns and complaints, upsell. So how much more of a product can you attract a customer responsibly to take on, as well as cross-sell? So will they have a larger wallet in terms of the products that you provide them as well? And emotional metrics, customer acquisition, net promoter score, customer satisfaction recommendations, customer engagement time, unique visits, communications opt-ins, referrals or member get member, satisfaction, social media virality. By that I mean likes, shares and mentions, as well as brand loyalty. So there's a set of customer experience metrics that are crucial. This is an abstraction from a fantastic paper by McKinsey called Creating the AI Bank of the Future. I urge you to read that, from 2020. And what this shows is how artificial intelligence and machine learning is being applied in the customer life cycle of a lending customer experience for both small businesses and retail customers. And in each of those core components of the lending life cycle, from customer acquisition to smart servicing, not only are there AI and machine learning applications in each of those, but most importantly, have a look at the bottom row. There are some key metrics for each of those components, each of those chains in the customer value chain for lending. So from customer acquisition, monthly customer acquisition run rate, credit decisioning, credit approval turnaround time, percentage of applications approved, monitoring decision, average days past due, deepening relationship, deposit, assets under management attrition rate, and then servicing net promoter score. It's a really nice graphic. The scope for operational efficiencies is wide. I was just going to ask, am I able to run slightly over time? Mediator? Compare? Hello?
You still have 10 minutes left before you end your presentations.
Okay, so it's only the 10 minutes. Okay,
Yes.
I'll have to speed up. There's no extra time, is there?
What about the extra time? Could you give the extra time?
Possibly another 5 minutes. But anyway, let's see how I get on. So the scope for operational efficiencies is huge. So across the board, from management, treasury, risk and compliance, the functions within each of the different SBUs, product, sales and marketing, project office, finance, HR, legal and admin, customer service, back office and IT, huge scope for operational efficiencies. Some of the operational KPIs to apply include costs. So what are the operating and variable costs versus the fixed and capital? Quality, what's the level of differentiation, value add or fault rate reduction? Productivity, so is it about accelerating throughput and lowering cycle time, or is it about increasing automation and reducing personnel spend and dependency? Increasing capabilities were mentioned. So what's the skill development to increase competitiveness and differentiation? It's about improving access, scope, and skills transfer, as well as core business risk reduction, the 7 key business risks: operational, reputational, security and fraud, financial and cash flow, regulatory and compliance, economic and competitive. This is also from McKinsey. This is the operating model drivers model. And it's a really good way of being able to assess at a high level all of the different. Now, this is originally designed for a manufacturing value chain, but actually when you consider most of these elements, actually you could apply this to core operations within financial services. And I think it's a great way of thinking through all of those operational KPIs that you can develop to ensure successful transformation. And then lastly, sensitivity is really important. You know, establishing a change in value of a specific key variable in your model, you're gaining insight into the most sensitive variables which you need to measure and manage for your solution to be successful. Common variables include customer acquisition, revenues, average revenue per user or ARPU, pricing, and customer acquisition costs. Very important to do your sensitivity analysis. And what are some of those ongoing KPIs to manage your transformation solution and establish your ROI? So volume growth, customers, clients, businesses, revenues, ARPU, average revenue per user, growth in monthly recurring revenue, customer acquisition cost, margins, and cohort analysis and churn. So each different segment that has come into your business for a new proposition, what's the churn on that? So what's the final checklist? We've covered all the key metrics to establish the value, viability, and priority of your transformation projects, whether it's a new or improved customer experience, new proposition, or an operational efficiency. But don't forget to apply these key tests. When sizing a market top-down, always stress test your serviceable obtainable market by running bottom-up calculations. Remember the 4 Ps of experience when considering how to improve customer experience and journey. Use the profit model decision tree and McKinsey's operational drivers to identify ways to extract efficiencies and to improve volumes and margins. Use the business model canvas as an aide-memoire when building your business case and financial model. And always run sensitivity analyses because A, it validates or invalidates your key assumptions, and B, identifies where to prioritize making improvements in the future. Again, from McKinsey, the 6-stage digital transformation model, I think, is very, very helpful, starting with customer experience at the top, through to product and service innovation, distribution and marketing and sales, digital fulfillment, risk optimization, and enhanced corporate control. And across each of those core components, McKinsey assert that it's important to think about, well, what is the decision making? What are the outcomes you're looking to achieve? And how is each of these experiences looking to affect, to create the right kind of decisions that you're making as a bank and a customer might make when it's served from a digital customer experience? The connectivity, what's the best way in creating that kind of that link and loop between different customers and different digital media? Innovation, what's the ability as a bank to create those new products and business models? And then, of course, from a cost efficiency, speed, timeliness, personalization aspect, what level of automation can you build in as well? Very quickly, we talked about a digital transformation maturity model as being part of the digital transformation mix. Well, this is, I think, one of the best digital transformation models by Tony Sandana in his book, The Financial Brand. And, you know, it shows 5 key levels: foundational, stage, siloed, partially synchronized, fully synchronized, and what he calls living DNA. So what are some of the risks? So more than 2/3 of all bank transformations fail. Lack of clear and distinctive strategy and purpose, unclear goal and processes to execute those goals. Failure to form a distinctive strategy, being being viewed through the lens of automation, and not reinventing business models. So only seeing transformation as a cost efficiency play. Many banks miss out on the opportunity for business-wide transformation because they see transformation as a way to create incremental products and services only, or channels. Others see transformation as a reaction to regulatory and technological channels, and so are reacting reactively. Many digital transformations are run using traditional IT project management methodologies, and the culture is not set up to fully live digital transformation. And then many banks find it impossible to re-architect themselves as virtual value chains and to decide where it wants to play in the new value chain, and fall into the spaghetti of multiple integrations managed poorly. Again, I want to go back to Piyush Gupta from DBS. I love this quote: "The best way to fight disruption is to preempt it and disrupt ourselves." I think that is such an inspiring quote. So DBS, I very briefly want to talk about. So it started with redefining itself as a tech business more than a bank. So instead of being seen as a cheaper channel, digital informed all elements of the bank strategy, from new business models and new market entry through to customer experience, through to operating over the cloud. It's leading in all facets of transformation: culture, technology, new business models, and ecosystems. So DBS and Piyush Gupta envisaged a future where banks without a clear strategy would be relegated to just back-end processing or balance sheet funding. It saw its mission to be the best lifetime partner for its customer clients, saw cloud as a way to become more agile, and transferred core systems to the cloud. And new business building and ecosystem development became central to its strategy. And it really lives and breathes continuous digital innovation. 2021 saw the first bank-led digital assets and carbon trading exchange launched, and it's developed an open API platform to enable third-party providers to build offerings within the DBS platform. I've talked about Chime a lot. So it was set up in 2014 to create the best digital banking app experience. It built a platform bank before anyone had heard of the term. Recognized with the advent of banking as a service and cloud, it could insource everything it required and create a disruptive neobank. Working with partners such as Quilio in particular, Snowflake and AWS, everything is sourced from trusted third parties. And it's so popular, it has the highest NPS ratings in US banking history of 66, and it's a most recognized FS brand for under 45-year-olds. And now, very interestingly, as I said before, the only thing that Chime has that it's developed itself is an intelligent interface layer where it's used artificial intelligence to make the right kind of decisions on behalf of customers in terms of what their needs are. And that interface layer has now been made available via APIs into some regional banks, in particular its curated retail investment platform. And BBVA, very quickly. So back in 2015, the chairman then announced that the bank's #1 strategic priority was to become the world's best universal bank of the digital age. In 2015, a new organizational structure called the Global Digital Bank comprised 4 units: ecosystems and new ventures, global products and services, global technology, and talent. I think it's fantastic how they had such vision, organized themselves to make them a leader in digital transformation. Within 6 months of that decision in May 2015, the decision was made to build BBVA Open Platform, which became the banking world's first banking as a platform. And simultaneously, BBVA created a new revenue model and transformed its own offering. So BBVA Open Platform is a one-stop marketplace of product and infrastructure APIs, and it's extended its ecosystem to drive innovation and new market entry. And then lastly, Starling Bank. So it launched in 2017 with open banking, with a vision to create a completely digital bank who curated the best suite of services to make the lives of small businesses and consumers easier. From the outset, from 2017, it had a set of values and operating principles that define their journey. to meet all the needs of real world customers, to put customer experience at the heart of everything we do, bring passionate collaboration to building things, and build with a passionate collaboration. So, I mean, it's very interesting. They liked it so much, they had to stress it twice. So they saw, as part of open banking and a fragmented value chain, that collaboration was the most important thing. Developing partnerships, creating the ecosystem was so important they had to say it twice. So they built a platform banking ecosystem from which to combine the right suite of products, and they have continuous upgrading across the entire business. It's entirely cloud-based, and so data structures, operations, and tech are continuously renewed. And the focus is on integrating third-party data analytics and artificial machine learning capabilities to offer more personalized and instant services. So, conclusion.
Jeremy, sorry to
clarity
interrupt, but you only have 5
This
minutes.
is the last slide.
All right.
Can I say the last slide? So clarity about strategy and customers is essential to guide transformation. So common to all of the exemplar successful transformations was a clear and powerful strategic vision and mission, a vision that challenged existing assumptions and reimagined what banking could be. Central to each of those strategies was clarity regarding markets and customers. In an era of cloud, banking as a service, and open APIs, traditional value chains are being fragmented and unbundled, and banks must be clear in which slice of the value chain it wants to compete in. Banks must evaluate and exploit the opportunities of open banking and open APIs. Leadership in data, analytics, and artificial intelligence, critical capability. A relentless focus on customer experience is the hallmark of the world's best banks at digital transformation. Cloud-based platforms can ensure that future-proofing, and ensuring the right digital mindset, culture, organization, and ways of working creates a dynamic for change and becoming a bank customer service. So the final slide, this is the founder and CEO of Wise, formerly called TransferWise. So we had Steve Jobs at the beginning giving his view of banks in 2007. Earlier this year, Tarvet had some wise words. I met him a number of times. He said, many ideas sound interesting on paper, but are not viable in practice. Some ideas are interesting and viable, but not feasible without a large sum of money. And then here's a positive remark. Other ideas are interesting, viable, and feasible with a little bit of funding and hard work. Thank you very much for listening. I hope you've had a lot of interesting thoughts coming out of the presentation. I've certainly enjoyed it, and I'm looking forward to your questions at the end of the session. Thank you very much.
Thank you very much, Jeremy. A lot of very interesting points that you've just stated. Jeremy Larson, if I may sum up what just Jeremy presented, there's a point about the digital transformation and also what it encompasses, and also Jeremy explained to us, elaborate about digital maturity model, and it is very quite fascinating model structures and also the matrix and canvas. Jeremy stated 6 components of digital transformations matrix, from strategy, data, customer experiences, tax and operation platforms, ecosystem and new models, people and culture. They are also slightly about reframing where to play in the value chain, seizing open banking, open finances, and what Jeremy just mentioned about the digital transformation of the traditional banking is making the banking value joyful, right? And also there were 4 P's of digital customer experience, which are product, price, personalizations, and place. Jeremy also explained, elaborate about integrated model of digital transformations of using data for incumbents and challengers. That was very fascinating. And if you have any question towards Jeremy's presentation, just put your questions on the Q&A section, and don't forget to put your name of institutions and your questions, also the speakers to whom you deliver your questions to. All right. Distinguished guests, ladies and gentlemen, we would like to invite our second speaker for today's event, the Managing Director, Asia Pacific Thought Machine, Mr. Nick Wild. All right, I would like to give a brief introduction of Mr. Nick Wild. He is responsible for building Thought Machine's brand and scaling its deployment in Asia Pacific from the regional headquarters in Singapore. He has over 20 years experience in senior sales and business development roles within the banking software technology enterprises across Asia Pacific, Europe, North America, and African markets. Prior to Thought Machine, he was Chief Sales Officer at Vis-a-Vis and led the establishment of an Asia Pacific digital identity and broad business for Experian and the creation of Vis-a-Vis integrated Asia Pacific business, which profitably grew to over 100 million US dollars. Ladies and gentlemen, please welcome Mr. Nick Wild.
Wonderful. Thank you very much indeed for a warm introduction. Thank you for the invite. I have two tough acts to follow, both very visionary, inspiring, and comprehensive. The approach I've taken is Thought Machine's been in Asia Pacific for about just coming up for 3 years now. What I thought I'd do is distill down all of the conversations that we've had with many large and small banks across the region over those last 3 years, and try and sort of illustrate what it is that how different banks are thinking about the digital transformation journey. Some of the data points around that. It won't be a sales pitch, that would be inappropriate. It really is about the lessons that we are learning from people that we are talking to, and I hope that will be of interest. So, to give you a bit of context first, banks have been dealing with the move to digital for well over 20 years now. Enormous sums of money have been spent, certainly in the billions if you added it all up around the globe. And frankly, great things have been achieved. I mean, banks should be, for all of the comments from Steve Jobs, and you'll see one from me shortly around Bill Gates, it has to be said that incumbent banks may have been a little slow off the mark as the digital evolution started, but especially during the recent COVID pandemic, all of them have shown an ability to get phenomenal things done under very difficult circumstances. However, what I would argue, based on all the conversations we're having, is what banks have dealt with over the last 20 years is evolution, is digital evolution. Now, certainly very rapid evolution, and the pace is increasing, but not the revolution, and not the revolution that Amazon caused to high streets, that Netflix caused to the video stores, and Uber have caused to taxi companies. What has happened in those instances is in my mind an example of true digital revolution. And I'm old enough to remember when Amazon first appeared during the first .com boom, and I'm also well remember that they were ridiculed for quite a few years, especially by bookstores. Because who would buy a book from the internet when you can wander into the store and actually touch and feel the books? Well, now, every bookstore in the world has been impacted by Amazon, and further than that, every shopping centre and every, pretty much every aspect of mainstream commerce has been impacted by Amazon. So it seems to me that the way that digital revolution goes, if you look at the lessons across it, is at first it happens very slowly, and then it happens very, very, very fast. So will it happen to banks and financial services? I mean, Bill Gates 20 odd years ago predicted we need banking, but we don't need banks, and we would see the death of banks, or the large marginalisation of banks within a few years. Now, clearly his timing was wrong, But if you look at the recent Gartner statement and you talk to the bankers that we talk to, for those of you who know Thought Machine, you'll have seen that JP Morgan Chase, run by Jamie Dimon, has recently become not just a customer of ours, but an investor. And if you read the way that he's viewing the threat, he's not worried about the Bank of America or Citibank or whatever. He's worried about the technology challenges. Now, whether that's Google or Amazon or Apple or somebody that's still in their garage, he is genuinely paranoid, and sees that JP Morgan Chase has to proactively address the challenge before it arrives on his doorstep. Banking's been somewhat, so why is the banking revolution? Why has it come, or why is it coming later than commerce and entertainment and transport? And I think the answer is there have been a number of barriers to change, a number of barriers that have protected incumbent banks. And these are a few that I've distilled down. It's not a comprehensive list, but again, it's the main ones as I talk to various bankers and regulators and different analysts. So traditionally, legislators and regulators have been very, very cautious about letting new entrants into the financial system, because they're obviously so critical, not just to the country and the systems, but regulators have an incredibly difficult job to balance the need between giving consumers the services they demand, but protecting them from experimentation, if you like, and certainly from ruthless exploiters. But what we are seeing more and more in the last few years is regulators and legislators as activists, very much as our esteemed host at the beginning talked about around the subject of financial inclusion. So we're seeing things like open banking, which Jeremy mentioned a number of times, and clearly gave a number of examples of how that's coming. And in terms of data points, one of the reports that I pulled said that open banking this year is worth somewhere around there's about $15 billion flowing through open banking. That will grow to $37 billion US by 2025. Now, clearly, incumbent banks, will benefit from some of that transition, and a number of you are, obviously working hard and doing great things to make sure that you do, service customers and see some of that. But many banks are going to see revenues intercepted by, platform players such as Grab and Gojek and all those sorts of things. It also makes, this open banking, and it also makes the competitive environment, even more complex than it's traditionally been. So banks are going to be under enormous pressure to adapt more quickly. And as Jeremy talks about, not just adapting in terms of, we've added internet banking, then we've added mobile banking. Next, it'll be, the Internet of Things, and our cars will be buying their own petrol. But in terms of the business models, which he also talked about. One of the other barriers that has traditionally protected banks, incumbent banks, from new entrants is the sheer amount and richness of data that customers have shared with them that allows them to make incredibly smart credit and risk decisions. And it's been very difficult for new entrants to compete against that. Again, open banking lowers that barrier. One of the other key things that I'm seeing as I talk to various CTOs, CIOs, and all that sort of thing is the idea of that all of us are creating more digital exhaust than we've ever created in history, and that's just accelerating. And that's through our use of e-commerce and social media and gaming and other digital services. such that by 2025 or in 2025, we'll generate collectively around the world about 180 zettabytes of data on top of that which already exists and is stored. Now, a zettabyte is 1 trillion gigabytes. Now, within that data, within this data is a whole new rich set of information which can be used to make smart decisions on credit and risk. So even where open banking is not available, with the new technology that we're seeing coming in, and artificial intelligence and machine learning, and the services that the cloud vendors such as AWS and GCP and Microsoft provide as well, the combination of those things allows new entrants to make smart decisions, build alternative models, and it gives them access to new segments. And again, very much in the space of financial inclusion. So the traditional models and credit bureaus rarely cover those, the underbanked or the unbanked, and it's difficult for incumbent banks to serve those communities cost effectively. The organizations like Grab that have and Gojek and others that have such a strong connection to those workers, those micro SMEs, the drivers and the taxi drivers and the delivery riders and those kind of things, they are gaining an insight in how to properly understand the patterns of those people and be able to serve them. And as we move to a gig economy, increasing to a gig economy and a high entrepreneurial state, especially in Indonesia. So I think 700 or 800 million SMEs, of which 98% of them are micro SMEs. In other words, individuals or husbands and wives or brothers. I mean, they are woefully underserved by incumbent banks. So, what are some of the other challenges that banks talk to us, and why they come and talk to us? So this links very much to some of Jeremy's 4 Ps. I've said that banks have done a phenomenal job in the digital evolution and catching up. The challenge, I think, for banks, whether you're a neobank or an incumbent, is there is so much investment and so much sort of smarts put into the mobile apps and the digital channels these days. It's increasingly hard for a bank to stand out. One app provides much the same services as the others. It's not yet at a position where it's completely flat and there's no differentiation at all. But I think we're definitely in the period of decreasing returns. More and more money is being spent to make smaller changes in many cases. There's it's not meeting. Banks are being judged against the experience of e-commerce. They're not being judged against each other, being judged against the experience of e-commerce. And the generational transition that's going on, the wealth and the money and the work is transitioning to a generation of people who seemingly were born with a mobile in their hand. And what's more, those people are increasingly taking the jobs of CFO, CTO, CEO, CIO of businesses. So it's not just the consumer segment that's changing, becoming more demanding, but the businesses are as well, which again increases the pressure on incumbent banks. So why is it so difficult for many incumbent banks to change at this speed? So if you look at a bank and a bank reference architecture, look at a very high level, looks something like this. It's complicated to run a bank. The real problem, though, is in reality for an incumbent bank, it looks more like this, right? What you have is a set of decisions that have been made over 20, 30, 40, 50 years. And they've used the best technology that was available over the time. Nobody is, or very few CIOs, CTOs, and C-suites have been given the opportunity to start with a blank piece of paper. So you are continually wrapping your old technology in new digital technology to try and meet these new demands. And this has got to a point now where it's so complex that it's become not just expensive to run, but also extremely rigid. So what does that, what does that really mean? So, yes, that sounds fine. What does that really mean? Well, if we look at buy now, pay later as something, that's exploded onto the market across the world in the last few years. So to my mind, when I first saw buy now, pay later, it's not a business, right? And I think we're seeing a lot of these businesses now really struggle to stay. They grew enormously at the beginning, and many of them are falling to the wayside. It's not a product, it's a feature. But the reason these organizations were able to get out the gate and create valuations of 29 billion and to wreak havoc on the credit card portfolios and the consumer loan portfolios of incumbent banks is because in many cases the architecture the legacy architecture we looked at before prevented the bank from being able to create a buy now, pay later feature onto their products. It is not that bankers sat there and didn't believe it or were too silly or not smart enough to understand it. Many bankers that we've spoken to over the last 3 years desperately wanted to do it, but their legacy environment architecture prevented them from rapidly creating a new product and getting it out to market. And I believe that, not only has it created a lot of damage for, on banks' balance sheets and P&Ls, given the desperation of some fintechs in this space to, continue to grow at any space, they perhaps, lent money to people who, were extremely vulnerable. So I think there is a social element here as well that, banks have built up over many years a social responsibility and an understanding of what happens if you make bad credit risk decisions. It doesn't just cost the bank and its shareholders money; it can create genuine pain at the individual level. So I said before that very few C-suites have had the opportunity to start with a clean sheet of paper. That's especially true in the core banking space where we are. Bank core transformations have been almost the last choice for any project in any bank. That's evidenced by some work we did with IDC, some primary research we did across Asia with IDC not long ago, where we found on average most Asian Pacific banks are on second and third generation technology. So the core is at least 20 years old, and it's being asked to sit at the heart of a system that is serving the internet, which was not around when it was invented, mobile, which certainly wasn't. And as we look into the Internet of Things and blockchain and cross-border and real-time and all of those sorts of things, there comes a point at which there's only so much digital wrapping you can put around the core, and the time is coming where many of the banks we're talking to are feeling the real pressure to change and make the hard decision. So the reason that we exist is, and that companies like us exist, is the belief that that cloud and APIs and microservices and all of the associated technologies allows us to start to create some solutions that offer banks, old or new, large or small, new capabilities. So a digitally native service or product has to be cloud native to provide, and truly cloud native, not lift and shift, so that you can take all of the advantage of scalability, resilience, availability, and security. Fully microservice and API enabled to ease integration within the bank and outside of the bank estate for all of the reasons that Jeremy talked about earlier, and I'm sure Dan will next. And the ability to support a service-oriented architecture such as that provided by Anne, where rather than hyper integrated black boxes with lots of digital wrapping, you end up with modular, loosely coupled modular systems that are easy to plug and play to allow the bank to agilely sort of adapt to changing demands. And that's not just creating new products, also new business models, as was discussed before. And if you think about it, I mean, all banks are another symptom of legacy core, which is where most of the products are defined. Banks have been selling the same products for many years, right? When was the last real product innovation product innovation that really came? There's been tweaking, those kind of things, but things like BNPL, credit cards, debit cards, different types of mortgages, it takes a long time for those things to happen. That's got to change, because if you are going to follow the 4 Ps, and I've not seen the 4 Ps before, but I absolutely identify with the message. It's going to be all about, products that people need, where and when they need them, embedded finance, hyper-personalized, so we get away from the digital sameness that we're starting to see. This kind of technology also gives a significant cost advantage in 3 areas. The cost advantage for build the bank. So if you are building a greenfield bank, you can now build it for tens of millions instead of hundreds of millions or billions. Run the bank. We did some work with Bain a couple of years ago. Again, some primary research on tier 2, 3 banks and what it really was costing them to run legacy, and then looking at those equivalent banks that had built a brand new digitally native stack, not just the core, but the entire stack. And what they found was, on average, a modern stack cost only 35% of a legacy stack. So if you think of the impact that your IT has on your cost to income ratio, the ability to bring that down to 35% of what you're currently paying is a huge thing. And again, if you can lower the cost to operate, lower the cost to build, lower cost to run, and lower the cost to change, then you can affordably service the unbanked and the underbanked, and do well by doing good. In terms of what that will take, I said core transformation is probably the last on anybody's desire to do as a project. The other thing that modern technology allows you to do is, rather than the black box to black box big bang, is the ability to do incremental migration, control the risks, chop the costs up into pieces and control those better, and be able to get revenue opportunities at each stage. So what does this actually look like for banks that have done it? So Mox Bank is a greenfield bank, a Standard Chartered bank built in Hong Kong. Hong Kong, 6 million people, 130 odd incumbent banks, and 8 new digital banking licenses. What they were able to do was to build a highly differentiated product on day one that offered the mobile account, the debit card, and allowed customers to dynamically create and destroy their own savings pots underneath. So they didn't have to apply for savings accounts. They could create and destroy them themselves, whether it's for rainy day or longer term for investment or anything like that. And then every few months, they were able to keep releasing new features. So the next one was the pre-approved credit card, which by itself is not that revolutionary, except in this case, when you accepted the credit card offer on your mobile, not only did you have a credit card facility on your mobile app, but the plastic debit card in your wallet instantly became a hybrid debit credit card. So the plastic, which still gets used, instantly became, you didn't have to wait for the credit card. There are, underneath this main account are loan accounts and all of those sorts of things. So again, the customer's not having to apply for each account. They're able to pick those features of a single account that suits their need and adapt it to their needs. So hyper-personalized, and for the bank, although it looks like, a different product for every customer, for the bank it's a single product to manage. Personalization at scale is what happens when you have product as code instead of product as system. And it allows the bank to keep all the personalization and the differentiation in-house while using SaaS to outsource the utilities. In Scandinavia, one of the largest Scandinavian banks applied kind of that similar innovative thinking at the micro SME level. So particularly pertinent to Indonesia, I think, because there is such a high degree of entrepreneurialism in Indonesia, and they are, traditionally poorly served. This again is an app with a card. The idea is for those micro SMEs, those individuals, often their personal life and finance is so tightly coupled with their business life and finance, it's hard for them and the bank to separate it. The idea is here a single card, and on the app there is a master account with a customer, a personal account, and a business account. When they open the app, they get a list of today's transactions, and almost like a dating app, swipe left for a personal transaction, swipe right for a business transaction. Helps them separate what's business from personal for themselves, helps the bank understand what they need from a business point of view and make offers that are in the context of their personal lives, and similarly on their personal side, make offers in the context of what's going on with their business. Incredibly successful, incredibly unique, and impossible to do without a modern digitally native core platform at the back end with product as code. So the last slide I'll leave you with, because I'm running a little right up against time, but similar to some of the quotes from Jeremy's thing, that I really truly do think Bill Gates was wrong in his timing, but he was right in his call. I do believe that Gartner, are right in saying that banks over the next 6 to 7 years are going to be incredibly challenged by techs, by other banks that are making the moves. And we're seeing banks like Siam Commercial Bank, a very traditional bank in Thailand that has devolved itself into a set of fintechs plus a run bank. So they've got the power of an incumbent bank, but the agility of a family of fintechs. And I truly do believe that, we are facing into a future where banks either invent their future or they will be retired by it. So I'll leave it there, and I apologize. I've slightly over time.
Just slightly. Thank you, Nick, for your presentation. You've just elaborated to us, explained to us about how important it is the digitally native core to transformation of financial sector. And you also stated how important it is for hyper-personalization is needed to the API or application platform interface to give the best experience for the financial sector. And we will discuss more about your topics on the Q&A session. Thank you very much, Nick Wild, for your insightful presentations. Distinguished guests, ladies and gentlemen, we would like to invite our third speaker for today's event, partner of Oliver Wyman firm, Mr. Dan Jones. I would like to give a short brief about his resume. He works across Asia in Oliver Wyman's digital practice, where he supports global clients to digitally transform their existing businesses and also launch new greenfield ventures on modern, low-cost technology stacks using agile and lean ways of working. He specializes in the development and launching of new digital business models and virtual banks, products, and services. Dan has worked across Asia, Europe, and North America, and most recently led the launch of 2 new virtual banks and a number of new digital initiatives for 2 global financial institutions. He's passionate about moving existing organizations into new ways of working and partnering with fintech firms to design innovative products for the market. Dan has previously worked at a large global consulting firm and has spent time working on the industry side with a large European bank. He studied marketing and management at the University of Newcastle. He is a certified agile practitioner and coach and holds a PMP certification in program management. Ladies and gentlemen, please welcome Mr. Dan Jones.
Great. Thank you for the warm welcome, and hello everyone. It's a privilege to be talking to you today. And we've heard a lot so far from Jeremy, from Nick, around the opportunity, what's happening in the industry, and I wanted to talk a little bit around some of the pitfalls, some of the approaches that you can take if you are indeed a bank who is about to embark on your digital transformation. So I guess as Oliver Wyman, we are in a privileged position to talk to a number of incumbent financial institutions, and what we do see every single week is that digital transformation is not a nice to have anymore. It is absolutely critical for survival, and in those board meetings that we would go to, almost always in the top three topics of discussion is how does the institution transform. And some stats here that you can see that 87% of senior business leaders recognize that digital transformation is a priority, and 91%, and I would argue that that's actually even higher, of businesses are engaged in some form of digital initiative. And I'm sure that not all of those initiatives have been successful. There are many success stories, some of which Nick just shared around MOX with Standard Chartered, for example. But I'm sure you'll also be aware of examples where companies have engaged or embarked on a digital transformation journey, spent lots of money, but not necessarily seen the return on investment that they were hoping for. So we wanted to talk a little bit about the different approaches you can take based on many of those lessons learned that we've had through working with clients in the industry as we've partnered with them on that digital transformation journey. So I guess, first of all, some of those factors that have contributed to the growing and present urgency is that increase in cost of integration. So those legacy systems that many banks have, every year the cost of running those goes up. The number of people who understand how they run goes down, and typically you have to try and pay those people more and retain them and retain their expert knowledge. And as those new cloud solutions come online, the overall cost of your IT estate is typically going up. And that covers from new changes all the way through to maintenance as well. And as regulations change, upgrades and just keeping the lights on of those systems becomes a significant cost burden in a bank's overall cost base. But it's not just those internal factors that we are seeing. It's also the external factors. And Jeremy talked a lot about customer expectations and having delightful customer journeys. And that is now the hygiene factor. That is the basic expectation. Customers expect to be able to engage with a bank as easily as they can order from Gojek, as an example. So shifting customer expectations has long been a challenge, but many banks are still trying to catch up, and by the time they've caught up, they've realized that those expectations have changed again. So it's not just about meeting those expectations today, it's actually looking forward in 5 or 10 years to understand how customers actually want to bank then, starting that work now so that we can meet those expectations with our technology and operations that we supply. But furthermore, with the financial pressures that we're seeing around the world, that has also given light to a number of new business models. One of the main examples here is banking as a service, where a number of financial institutions are realizing that they can tap into new revenue pools of existing customers who are sitting on digital platforms for non-FS companies. So that could be a travel website, it could be a gaming website, it could be an e-commerce platform, for example, where you can embed financial products into those digital platforms and reach a very large pool of customers, or a captive audience, at a very low cost of customer acquisition. So it's the same banking technology and operations, but it's been repurposed in a different business model. And the demand for increased top and bottom line performance is driving these financial institutions to now look at this and to have a technology stack that is capable of meeting some of those business models. And one key KPI that we often look at here as what good looks like is the cost the cost per year of having one customer account. So typically that should be in the range of 20 to 30 US dollars. BBVA that Jeremy mentioned, for example, is roughly in that range, but many institutions are higher than that because of their legacy cost. And that restricts them in terms of some of the business models that they can then offer. So we are seeing this drive now to reduce the cost of the IT technology stack so that they can offer these new business models. And finally, we've talked a lot today about increased competition, but the regulatory and industry shifts as well are contributing to that. So having the flexibility and nimble way of working so that you can respond at a bare minimum to the regulatory changes that you need to make. And then on top of that, the more customer-facing changes that you would like to make, you've got to balance both, right? You can't obviously not focus on regulatory, but you can't focus so much on regulatory that there's never any time to improve the customer experience. So balancing those two has become critical, and making sure that you have an agile way of working so that you can roll out these changes to your technology stack quickly and cost effectively is now a key success factor in any digital transformation. So we see three different pathways for digital transformation, and each have their pros and cons, and some banks are more suited to one over the other. So the first is a greenfield launch. So essentially building a bank from scratch on a modern, scalable, usually cloud-based architecture. And this could be a new brand, or it could be the existing brand, but on a new technology stack. So Mox, as an example, which was owned by Standard Chartered, the incumbent bank, took this approach to build pretty much everything from scratch, and they are attracting both new to bank customers, but also it's an attractive option to their existing Standard Chartered customers as well, who want that improved digital experience. And we've seen this pioneered, particularly in Europe, with the likes of Monzo, Starling in the UK, and increasingly we're seeing this now in Asia. So, Hong Kong have issued their banking licenses. Malaysia very recently have issued their 5 banking licenses mainly to consortiums made up of FS and non-FS companies. And the approach there will typically be that greenfield approach to acquire new customers. But that is not necessarily suitable for everyone. So we do have option B here, which is essentially rebuilding one or some of your key or core IT systems if you're an incumbent institution, and migrating some of those customers and their data across. That does leave you with an IT estate that is, I guess, mixed. You will have some legacy, but you'll have some systems which are more modern. And over time, you then would gradually transform system by system. And this is an approach that we see typically taken by medium-sized financial institutions. And then finally, the modular transformation. Enabling a number of your core systems through APIs and integration layers, and step by step or customer journey by customer journey, replacing old back-end systems in a block by block manner. So this approach is typically used by the large global financial institutions, where they have millions and millions of customers, and therefore the risk of changing or moving customer data is high. And I'm sure we've all seen war stories where that sometimes goes wrong. So from a regulatory perspective, from a customer perspective, this is it's a very critical approach that you have to be very careful with. But typically, this is now the approach taken to move to more modern systems, such as Thought Machine as a core banking option, for example. And really, choosing the right approach is really a question of your volume and the complexity of your portfolio. So typically, new to market banks or new digital banks being launched would go for the greenfield approach. We probably expect to see a number of those arrive in Indonesia over the next 12 to 24 months. And if you're a larger customer, perhaps in a more mature market, then the modular transformation is the approach that we usually see being taken. And the second sort of axis here is really the complexity of your product and servicing portfolio. So again, the simpler greenfield banks will have a small number of products, whereas those established incumbent banks will have a number of retail, corporate, wealth and asset management type products and services. Most of their systems are intertwined across all of those products. So you do have to separate those. You have to enable those APIs, as I mentioned, so that you can step by step move customer and data over to your new target state technology stack in a very modular step by step fashion. And then on that modular approach, typically, we see this taking around about 4 years on average, but you can see incremental benefits as you go as early as year 1 or year 2. And what we would typically see is that in your first year, you would start to build the components of your new platform, or your first modules, if you like. And you would identify high-profile customer segments or even individual projects that you can use to move customers over gradually. So here you're decoupling your front ends, you're building your middle integration layer, you're building your APIs, and you're taking those initial steps to your target, more modern architecture. And this is really where Agile starts to kick in. So if you are an organization that hasn't really embarked on an Agile way of working before, typically year 1 is where your staff and your vendors get up to speed with that new way of working. They start to learn the methodologies of Agile and applying those and gradually getting better and better as the months go on. And then typically in over the course of then 2 to 3 years, you would identify those new customer journeys that you want to enable through those APIs that you've now built. You would start porting over some key segments of your customer base onto the new platform or your new modules. And then as you're getting your front ends up and running and customers are enjoying an improved UI UX experience, that's when you can start to really overhaul your back end. You can start to close down or sunset some existing expensive systems now that you've got customers on your more scalable, lower cost, modern fintech systems. So as we've seen a number of our clients go through these journeys, typically we see these key learnings from this type of approach. And these tend to be true of most types of projects, whether it's a greenfield approach or a modular longer term approach. And I think probably in order of importance here, people, organization, and culture and mindset are probably the most impactful success factors that we see, and some of the most common pitfalls as well. So the more successful transformations we've seen will have management commitment from the very top, and that commitment is very clearly communicated to all levels of the organization and the project. There should be no ambiguity about the direction of travel of your bank if you are doing to do digital transformation. And the more your senior management can be involved in the day-to-day decision making, usually helps, and it empowers and enables every level of the organization to understand that what they're doing as part of this transformation is absolutely imperative to the direction and longer term strategy of the organization. So having that communication, not just at the start of a project, but ongoing throughout is key. And this then has knock-on effects to the culture and the type of working that we want to enable through Agile as well. And then finding the right people in the right role is absolutely critical. So in particular in some Asian markets, people are generally quite new to working in Agile. In some markets, there's a shortage of developers with knowledge of frameworks that a lot of these modern platforms will have. So making sure that you have the right staffing and recruitment strategy in place and retention strategy up front is another success factor. And then organizing those people into Agile tribes. The tribe model was a variation of Agile that was championed by Spotify. And we find that this works well in a banking context also. So structuring them to make sure that they are that they're working in functional pods or tribes of people, but also that those different pods and tribes are meeting regularly to compare notes, to share lessons learned, and follow models such as the one Spotify used. We find is an important way of working to get right up front. On the culture, a growth mindset is absolutely imperative. What you can't have is people trying to do things in the same way that they have done over the last 20 years. That is, I think, it was Einstein that said, is the definition of insanity, doing the same thing over and over and expecting different results. We do have to change the way that we work. We do have to be focused on growth. And that is one of the common pitfalls, where we have people in roles who are just trying to do the same things that they've always done on a new project. So that's definitely one to watch. I think data-based decision making is also key here. So quite often we would see meetings where the voices in the room are saying, I think we should do this because this is just what I would want and this is what I would expect as a customer. That's not necessarily the right way to do that. We should look at customer data, customer research, feedback from customers to inform our decision making. We should look at system-generated data and use analytics to help support that decision-making at a leadership level, so that we are data-led in everything that we do. And then we have process and governance. So this is a balance between making sure that we have robust governance, as would be expected by any regulated institution, and balancing that with agile ways of working. And this is difficult to do. This is there's no right or wrong way of doing it, but very much a trial and error approach is typically what we see here, where we try and embrace agile, but equally there are always key governance things that we need to do. There will always be key regulatory reports that we need to submit and be very, very conscious of. And finding that balance is usually one of the success factors that are important in the first year. And then finally, on technology product and those providers, you do need to find the right partners. Whilst there's many sort of industry reports that will say this partner is better than this partner, or this technology is better than that technology, it's really about finding the right partner set for you. And that's not just about the product that they bring, but it's also about how they work. It's about their culture, and it's whether or not they see and understand the vision that you share as well, and making sure that you're all aligned on that and end up working as one team. So it shouldn't necessarily be one particular vendor telling you the way that things should work. It should be a joint decision-making process. It should be a joint way of working, and taking time to really understand your vendors from both a product, culture, and people perspective is also very, very important. And we are fortunate in Asia to actually have some very, very good vendors with that right approach and right mentality, who often bring a lot more than just the product. They do bring those lessons learned from previous implementations, and generally this is at a pretty good level compared to other regions that I've worked in the past. And then a final mention to cybersecurity and infrastructure. Whilst We are often customer-led and function-led. Cybersecurity is sometimes an afterthought, but it cannot be an afterthought. It needs to be embedded in our designs really, really early. It needs to, our product owners who are designing those customer journeys and writing those requirements need to be working very, very closely with the cloud engineers, the infrastructure and cyber engineers to really capture those requirements up front and make sure that the functionality that we're trying to deliver is delivered in a safe and secure way at all times. So that is a whistle-stop tour, I guess, of some of the key learnings and the approaches that we're seeing. I would summarize it by saying that digital transformation is difficult, but it is entirely possible. We, as an industry, are getting better and better at it. The capabilities, technology, vendors out there are getting better and better. And if some of you were involved in perhaps a project as I was 10 years ago, when transformation took 5 years and it cost hundreds and hundreds of millions of pounds with projects of 700, 800 people, that is not necessarily the case anymore. We are getting better. We're embracing agile. We're working with regulators more closely, more collaboratively, and we're working with vendors in a much more holistic and joined up way. So I do expect to see many more success stories, particularly in Asia and Indonesia, around digital transformation. It is not for the faint-hearted. It is definitely one of the more challenging projects that I'm sure that you'll all go on through your careers. But the opportunity to transform customer experiences and to really differentiate in the market and serve customers better is absolutely there. I look forward to hearing and seeing many of the successful stories coming out of Indonesia. So thank you very much for your time today.
All right, thank you very much, Dan Jones, for your insightful presentation. He just said that digital transformation is difficult but entirely possible. So if I may sum up the Dan's presentation, Dan stated that the force of transformation or digital transformation is the need to meet the external demands that have been a core driving force to transform, then renew the business model. And there are some success factors that need to be checklisted by the company to transform its business to the digital. First, people and organization, culture and mindset, and also process and governor, technology and product, also partners and the providers. Hope the Dan's presentation will help you to decide which is the right path of your business transformation. Depends on your volume and complexity of your portfolio. All right, distinguished guests, ladies and gentlemen, we would like to invite our last but not least speaker for today's event, LIBF guest speaker, Ms. Kat Keeley. She is an award-winning digital transformation expert and culture architect. Over 20 years of her career, she has worked with the world's biggest companies through lasting change, including designing the first open innovation platform for HP, re-architecting the way a UN agency does business, and designing a city-scale behavior change platform with Intel. She's now CEO of BIP, a platform that embeds the mindsets and behaviors that drive customer centricity by unlocking the problem-solving potential of people. She believes doing good is good business. She is chair of trustees for Frontline Life and a proud ambassador of the Burning Man Foundation. Ladies and gentlemen, please welcome Ms. Kat Keeley.
Hello. That was a wonderfully whizzy introduction. Thank you very much for that. So first of all, can I just say thank you so much for inviting me to be here. I am humbled. I don't know how many people are here in the room, but thank you for dedicating 15 minutes of your precious life to listen to what I have to say. So Jeremy asked me to talk to you about what does and what does not work as far as digital transformation goes from my research and from my experience over the last 20 years. So over the next 15-ish minutes, I'm going to talk about the way the brain works. And I'll explain why the way that most companies approach transformation is nonsensical and often fails. And I'm going to look at what we accept as normal through the lens of behavioral science. And I'm going to end by telling you the approach that works. And what I really want you to take away from what I'm talking about today is it's not what you do, it's the way that you do it. So as the lovely, remember the announcer's name said, I'm Kat Keeley. I've spent most of my life doing digital transformation. So 20 plus years before digital transformation was a thing, I was doing digital transformation. So I've learned a few tricks. Over the last few years, I've worked with a couple of financial organizations, and I'm not going to name who they are because that would be breaking confidentiality, but one is a multinational corporation that offers a range of financial products and services. And the other is a global credit and data company. One of them is seeing massive measurable impact from their transformation efforts, and one of them not so much. So I'm going to explain why after I've explained what good looks like. So before we do anything else, can we agree what transformation means? So when I'm talking about transformation, I am not meaning bringing in digital technologies to do more of the same. Transformation is a marked, permanent change in form or nature. And I think as the last chap touched upon, digital transformation can only be successful when it's accompanied by operational and cultural transformation. Transformation means a permanent shift in the way that your organization works, how the people who make up your company feel and behave. So to successfully go through change, you need to understand how the human brain works. And you need to keep that knowledge front of mind, no matter how much normal shouts out to you, as you're building your transformation strategies, your roadmaps, your activation plans. To get the best ROI from your tech spend, you need to learn how to shift mindsets and behaviors. And if you don't, your transformation programs will fail, just like 70% of digital transformation programs do. So the first thing you need to understand about humans, we are hardwired to resist having change done to us. So behavioral science holds the keys to avoid failure. So how many of you here have read Dan Ariely's books? I can't see who's in the room. If you haven't read Dan Ariely, then please do, because I'm telling you now, it's changed my life and he's become an amazing mentor and advisor to me. Let me start by telling you some really simple neuroscience. Our brains have hardly changed at all since the beginning of mankind. Humans have two key states. In the reward state, which we evolved to keep social groups strong, we are collaborative and we're creative and we're communicative and innovative. We make really good decisions. In the reward state, we are less change resistant. And this is my important point. And then there's the threat state, which we evolved to avoid being eaten by large carnivores. So in the threat state, neurochemicals are pumped into our brains that result in stress. And when we're stressed, the last thing we need to do is communicate or collaborate. We don't want to learn new things. We don't want to try new things. In the stress state, we just want to run away and hide. So collaboration is great. Communication is great. Survival is crucial. So human brains have 6 times more neural pathways constantly looking for threat. What on earth has that got to do with digital transformation, you're asking yourself? I want to ask you a favor, and I can't see you, so I'm going to have to trust you, but do this because it will help you to understand something really pivotally important. I want you to close your eyes for a second. And I want you to remember the last time you were told to do something by leadership when you didn't understand why. A new technology, a new leader, a new way of working. How did that feel? So it does not feel good. So every time a change project lurches at unsuspecting employees, the threat state kicks in. Whether it's a new technology, a new way of working, a new leader, every time change comes at people from out of the blue, the threat state kicks in. And we humans, and the neuroscience proves it, are herd creatures. So as soon as I feel stressed, the person next to me feels stressed, and it rises throughout the whole organization like a stampede. Stress. And every initiative that you bring out of the blue, that you tell people to do, makes people more resistant and less engaged. That's how unexpected change affects people. There are a bunch of unconscious cognitive biases that drive the way that every single human inside your company behaves. And understanding them will help you get change right. It will help you be successful. Number 1, we are hardwired to think that our own ideas are the best ideas. Number 2, we are tribal. We are hardwired to stick with our own kind. That means that oxytocin bonds us to our gang of like-minded folk. It provokes, at the same time, defensive aggression towards people who think and act differently, who are outside our tribe. Like when gangs of consultants appear from nowhere to design digital transformation strategies and roll them out. Number 3, not invented here. We have an inbuilt aversion to knowledge developed outside of our tribe. So that's what you've got to overcome. Conversely, there are some cognitive biases that we can harness to get it right. There is the IKEA effect. What does that mean? We place a disproportionately high value on the things that we have helped to create. If we've been involved with the creation of something, we will want it to work. We will look after it. We will make sure it works. 2, people, we release happy chemicals that make them feel good when they're allowed to surface a problem and to solve it, to overcome challenges, and more so when they're rewarded and recognized for doing it. And this is the biggie. This is the biggie, that every time you're trying to do change, keep this front of mind. We are hardwired to keep the status quo. We will do anything to keep things as they are. Humans are hardwired to resist having change done to them. Got it? So now, I'm going to tell you a story about the kind of things that people do wrong. You may or may not recognize this story. So a global CTO of a company asked me to work with him last year. When he took the job on, things were not great inside his company. So they had years of abuse by bad management. People had put up barriers, command and control leadership, disconnected silos, bureaucracy getting in the way of communication, endless, pointless meetings, people reacting to problems as they happened, that often caused problems somewhere else in the company. So it was a continuous, frustrating, expensive game of whack-a-mole. So employers they'd given up. Engagement and productivity levels were rock bottom. So the CTO, my friend, knew things had to change. So leadership designed and launched a massive digital transformation program. New platforms would enable collaboration and agility. Thousands of new people arrived with new skills and new ways of behaving, all with the mission of breathing life into the stagnant, inward-focused culture to drive customer centricity and, of course, to essentially create shareholder value. But when I started talking to him, his brilliant master plan was not working. There is an unbelievable resistance to the technology and to new ways of working, he was saying. So some of our best people are self-selecting to quit, even though they haven't got a job to. They would rather not work at all than work in this changing environment. And he just couldn't understand it. So knowing what I know, I'd say, well, that's a lot of change. So your internal comms director's got quite a big job on her hands. He says, after kind of shuffling around a bit, being uncomfortable, I'm not sure we've got an internal comms director. So we've got a situation where there's a reorganization, there's people going, new technologies, people arriving, new ways of working, over 100,000 people having no real clue what's going on or why. Here's a little saying, if you don't know it, keep it the front of mind. In silence lies fear. So with all of their good intentions, his global workforce was sinking into a quagmire of uncomfortable uncertainty. And the transformation program was failing. Why? Because peoples are not widgets. The threat state was kicking in. The herd was feeling uncomfortable. So let's look at the traditional operating model that too many people are still using. It was devised 200 years ago, and it's still going strong. In the search for simplicity and efficiency, companies are organized as a collection of isolated parts, separate departments specialize in people, in communication, in brand, in marketing, in IT, in business, as if they're completely unrelated. And enterprise tech providers persuade CXOs, whatever they are, to buy their highly optimized, brilliant technology solutions to solve their pain. The route to the utopian enterprise where data and technology will enable automation and drive efficiencies. And it's easier, let's be honest, to invest in tech, you know what you're getting, than to invest in complex, messy people. But the truth is, and we all know this, these separate units have never operated independently. Companies are not machines. They are like biological ecosystems, constantly evolving with increasingly complex interdependencies, not just inside, but across their supply chain. So these highly optimized solutions that many companies invest millions and millions of pounds into, unfortunately, often disregard the complexity of these systems. And more importantly, to the complexity of their most expensive assets, by which I mean people. You can't switch things in and out without the entire system being affected. But there's no doubt, but don't get me wrong, there is no doubt that you need to invest in digital. Of course you do, there's no question about that. But it's not what you do, it's the way that you do it. So if you want to be successful with your digital transformation programs, do not bring in a small army of outsiders. And I'm talking about this kind of traditional top-down upsell traditional consultants. Come up with a solution with your people. Harness the energy, the experience of your people, because humans are hardwired to resist change being done to them. So we, at my company, and the thing that I've developed over the last 20 years, use a really simple framework to help companies figure out how to get the best return on transformation spend. It's called the CREATE framework.
All right.
It's based on behavioral science, and it pulls together the pillars of successful leadership and the cultures that thrive on collaborative change, that love the change. And I've only got a few minutes left. I'm very aware of that, so I'm just going to touch on some of the elements. What?
Oh, actually, your time is up, Ms. Katz.
I haven't had 15 minutes.
I think you did. Oh, 5 more minutes? Yeah, we give you 5 more minutes.
Yeah, I thought so.
Yeah.
Okay, so the C in CREATE stands for communication. And that does not mean telling people the stats that you want them to hear, but real communication. Communication that makes them feel excited. Conversation, listening to concerns and fears. Communication that allows everyone to see and buy into the same North Star, to be able to imagine that kind of fitter, more efficient future of work. And stories, not stats, that kind of communication. C stands for change with your people. C stands for co-creation. C stands for collaboration between levels. C stands for change agents. This is the most important thing of what I'm going to say today. Change agents, the informal influencers. They can either be your biggest allies and they'll do your work for you, or they'll be your worst nemesis. So don't make the mistake of trying to get everybody on board immediately. Just focus on harnessing the power of your change agents. And they'll be your biggest allies if you harness the power of the R's in CREATE. And the R's are reward and recognition and respect. Now, this talk normally lasts about 45 minutes, so I'm just going to cut a whole bunch out because I've realized I've nearly run out of my time. But the truth, and as I was listening to the last chap, every financial company in the world is now being judged against the megatech players. Customers, we expect the frictionless experiences that we've become used to. So if you want to transform, you can't just bring in tech. You need to change the way that you lead, who you hire, how you behave, what you incentivize. So the CREATE framework are the conditions that these market leaders have embedded. Technology isn't a solution. It's an enabler to help you achieve excellence. So I mentioned at the beginning that I've worked with a couple of global financial organizations over the last couple of years. So the first, a credit company and data company, they did start dabbling in culture change. We did an initial piece of work with them. We identified the first change agents. We heard and harnessed what they had to say. We brought them together to surface the blockers that could stand in the way of success. We co-created solutions. We did some pilots. But the board were not transformational leaders, and the addiction to rational decisions from the top and the pull of how we've always done things, the status quo took over. The board decided their people were just too busy being busy to invest in change. And they decided to bring in one of the big consultancies to take the problem off their hands. The culture is pretty awful. The attrition rate is dreadful, and that transformation program will probably fail, and it will probably end up falling further behind its competitors. But the second is a massive success story. They're a massive financial consultancy, and they've been working on a holistic program that covers digital and cultural and operational. So there, we identified the change agents. They learned how to listen and learn from and empower. Their leaders are extraordinary. They understood they would not fix things by bringing in an army of outsiders to design. They understood that the only way to achieve success was to harness the full power of the people. Every digital transformation program is seen and acted upon as an opportunity to connect its workforce, to forge collaboration across business units. Leaders at all levels, in all departments, have finally realized that people is everybody's responsibility. And unless you do change with people, change will not stick. It's not what you do, it's the way that you do it. Thank you.
Thank you very much, Ms. Kat Keeley. Thank you very much, Ms. Kat Keeley, for the awesome presentation.
You're welcome.
Yeah, about neuroscience approach towards the subconscious behaviors of humans towards digital transformation. It is very interesting, Ms. Katz. Thank you for your presentation. And let's we straight forward to the Q&A session. We've received a lot of questions. And before we running out of time, we will straight to the first question. This question is for Mr. Jeremy Larsen from Ibu Ridiana Kurnia. She is asking, what is your opinion about the massive development of crypto asset and decentralized finance related with the business of digital banking? Mr. Jeremy Larsen? Yeah, go ahead with the answer.
Thank you. Ridiani, thank you very much for the question. It's very interesting, and I think what we're going to see is a whole suite of different financial services markets begin to develop parallel models. So at the moment, the DeFi space is, as you're probably aware, it's a very different operating model to that of traditional financial services. In the traditional financial services world, you have banks working under regulators' frameworks, which are monitored and managed by the regulators. As decentralized finance implies, that operates outside of a current regulatory regime. So there's a couple of implications here. You're going to see many more regulators develop approaches for decentralized finance, but you're also going to see some banks have a look at applications such as in wealth tech, such as in payments, and see actually whether there is a significant end consumer and business demand for DeFi solutions, which promise to be faster, cheaper, and potentially more repurposable and personalized than some of the CeFi or centralized finance solutions. So it's a really, really interesting area. Decentralized finance will obviously be facilitated via specific cryptos for specific use cases as well, and hence why there's a big conversation around CBDCs, or central bank digital currencies. Obviously, there's a bit of a problem given that CBDCs are run by central banks. So, you know, whether they have an opportunity to play in the DeFi space remains to be seen. But look, I think it's going to be a time of experimentation. Clearly, globally, we're in what's called a crypto winter. So that's knocking back quite a lot of DeFi initiatives and crypto initiatives at this point in time. I fully predict that there will be a further reinvestment in DeFi, particularly in Southeast Asia and Singapore. There's lots of DeFi initiatives. So there will be that confluence between the banks and neobanks and fintechs and DeFi. It's just a matter of time. It's just a matter of when. I'd say within 12 to 24 months, you will see some banks and regulators begin to have some policies and strategies in relation to DeFi. But might be good to hear Nick or Dan's opinions as well. Those are just my opinions, but great question.
All right, thank you, Jeremy. Nick, would you like to add some points towards the questions?
I'll be honest, I've really got nothing more to add. I think that was an incredibly sort of comprehensive and insightful answer. So, yeah, apologies.
Yeah, we got the second question. It's actually for you, Nick, from Ibu Dipta. She asked about the bank acquisition. Some big banks in Indonesia have acquired a small bank to be transformed from a traditional bank to be a digital bank. However, there are some banks which choose to digitalize itself rather than acquiring a smaller bank. They have been revitalizing their core banking with adding an AI. And what do you think about this phenomenon? Which one is better according to your opinion, Nick?
Yeah, so I think if I pick up on what Jeremy, Dan, and Katz have said, I don't think there's a single right answer. It really does depend on what is the challenge that the bank is facing, not just the business technology challenge, but the people challenge. And what are the ambitions? What's the vision? Is it, ultimately total transformation, or is it just initially to serve a new segment or a new customer, or launch new products? So I'm afraid, I'm not trying to duck the question. It really does depend on what's, where you're starting and where you want to end up. I mean, Mox was a greenfield digital startup by Standard Chartered Bank. The gentleman who was the sponsor for it internally, very visionary, and took the decision to set up a completely separate bank because he believed that leaving it inside the parent bank would create some challenges, and it was better to move it out and learn the lessons, even though it's difficult to start a new bank from scratch. If you look at some of the work that JPMC and Lloyds and the like are doing, they are taking a piece of their bank first and transforming it, because that's that's what they judge is right for them. So it's going to be a case by case basis and thoughtful contemplation, especially in light of what Katz has just gone through.
Challenges and also consequences. All right. Nick, move on to the question number 3 to Dan. Dan, the question is from Ms. Christina Hetty. She's asking how to improve digital financial literacy, especially for MSME players with the development of fintech against the financial resistance of MSME actors, especially during this new normal era where MSME actors are starting to rise from adversity after the COVID-19 pandemic.
Yeah, I think that's a great question. I think MSMEs in general, their needs have probably not been well understood over the last 10 years. And in particular now, as we've come through the pandemic, some of those needs have changed and evolved as well, as individuals and small businesses have had to. And I think one of the best techniques I've seen to really understand that and to improve financial literacy is using what we call a jobs to be done framework and ethnographic research, where you sit down and really spend time with those micro business owners to understand what their day-to-day looks like. And what we see quite often is that they don't really distinguish between their own individual finances and the finances of their micro business. And sometimes there's crossover, sometimes they're very similar. And a bank needs to be adaptive to all of those needs. And particularly on the sort of financial literacy points, what we increasingly hear from the research that we do is that they don't necessarily understand banking language. They just want to be communicated with using simple language that shows how their needs are addressed. And I do think that's something that many countries, not just Indonesia, is learning to do. I think there's a few examples out there where the idea of conversational banking is now happening, where you try and run customer interactions very much as a human-to-human informal style conversation, so that you try and communicate with customers more easily, make sure that they fully understand what they're signing up to, what their obligations are, and give them full transparency on the products and services that they're taking. And I do think that most markets have a long way to go to get to that point. It's also an increasing point in the Philippines as well, where more and more customers are taking up financial products, but are not necessarily understanding their obligations at the point at which they're taking those loans. When you do explain it to them, and when you do outline it, the literacy is there. But I think banks have a habit of making it probably a bit more complicated than it really needs to be. And there's a couple of examples in Europe where some of the new digital banks have started writing their terms and conditions in very simple, easy to use sort of layman's terms without any of the legal talk, to make it very, very clear to customers what it is that they're getting and what their obligations are. So I think a similar approach can be taken, in Asia, in Indonesia, particularly with the micro segment, whose needs have definitely changed a lot over the last 2 or 3 years.
All right. Thank you.
Might I briefly add to Dan's answer?
Go ahead, Jeremy.
So I was just going to say, very interesting and insightful answer from Dan. And what I wanted to pick up on is where he talked about the jobs to be done framework, which was developed by Clayton Christensen, the late Harvard Business School professor, in his book, The Innovator's Dilemma. But I just wanted to say that jobs to be done was actually the framework behind the original thinking behind the UK's first ever neo SME bank, which was Tide. You might have recalled my 2x2 graph where I talked about Tide using cloud and AI to develop new products and to enter into new business models such as marketplaces. And that was precisely what George Beavis, who I worked with in Group Innovation at RBS, had in mind when putting together Tide Bank. Do have a look at it. It's called Tide.co in the UK. And what it did was develop a modular approach to developing absolutely essential products and services, not just financial services products, but also like tax accounting and cash flow management, integrated into its digital bank, both online, desktop, and mobile. So just wanted to say that's a real life case study of using the jobs to be done framework in micro SME banking.
All right, thank you, Jeremy. All right, move on to the next question from Nur Aisyah to Ms. Katskili. How to ensure the robust of cybersecurity infrastructure on the process of transforming the banking system into digital ecosystem? Ms. Katz.
Good question.
Yeah.
As with any other system that you're trying to get in, and actually one of the things, Jeremy, that I worked on with the last financial institution was how to take jobs to be done and actually get people to work in that way. So working with another big security company, really at the end of the day, your cybersecurity is as weak as your weakest link as a human. So in one way, the cybersecurity, how you get people to buy into it, how you get people to set their mindsets and behaviors and start doing things differently is where you need to be looking. Because if people don't want to act differently, if they don't want to use those new systems, they won't use them. And at the same time, many of the mistakes that are made by people, and many of those mistakes are made by people who don't feel safe to speak up. I don't know if you know Amy Edmondson, but she talks a lot about this. The one thing that we can be sure about in any large organization is that things will go wrong. The biggest mistake that companies make is not allow people to speak about the things that will go wrong. So the biggest cause of risk is the fact that people actually don't get the chance to talk about the fact they don't really understand what they should be doing, or they can see risks that they don't share back. I hope that answers your question.
Once again, understand people and who you hire, who you invest your time with those people. All right, Katz. All speakers, Jeremy, Nick, Dan, Katz. Unfortunately, our time is over. We have received a lot of questions, but we'll not be able to answer all of the questions. But thank you very much for this session to all our speakers, ladies and gentlemen. We have to inform you that we already share a link of feedback form in the chat feature, and please fulfill before the Friday, 5th August 2022, as the requirements to get the e-certificate. You may also access today's materials through the link that have been shared by us through the chat room and OJK Institute's mini site on Friday, 5th August 2022. The materials and recordings at the OJK Institute mini site can be opened in the capacity building menu. Then choosing the how to measure successful digital financial services return on digital investment webinar, then the materials will appear on the page. All right, ladies and gentlemen, before we close our session, I would like to request the closing statement from each speakers. So Jeremy, you may start first for your closing remarks to summarize your this session.
Thank you. Well, first of all, I'm grateful to all the other speakers because they've highlighted some real world examples of whether it's the transformation of core banking systems and data structures, or whether it's around people and culture. All of those 6 components that I talked about, strategy, data, customer experience, new business models, operations, and people and culture, those 6 elements are all integral into getting digital transformation successfully achieved and for you to transform as a business. And obviously, have a look at all of those metrics that I provided. They will help you get off the ground and be able to think strategically as to what's really important for you to achieve from transformation. Thank you very much. It's been a pleasure.
Thank you very much, Jeremy. Next, Nick, please, with your closing statement.
Thank you very much. I think my closing statement would be revolution is coming. What we've been seeing is evolution. Revolution is coming. Change will never move slower than it's moving today. So, you know, if you're running flat out now, you're going to be running even faster in the next few months and years. And as Dan and Katz have pointed out, you know, change is not instant and it's not easy. And if you're a big incumbent, it's going to take time. So if that revolution, if that bend in the curve is going to come in 3 years' time, then how soon do you have to start? As I said, I think, you know, you either invent your future or be retired by it. If you wait until the threat becomes absolutely obvious, it may well be too late. But with all of the modern technology and stuff available, you're probably more ready than you think. And if you look at what you achieved during COVID, which was phenomenal, then you know, you've got a good basis for making the change.
All right, thank you very much, Nick, for your closing remarks. Next, Dan, please.
Yeah, thank you, everyone. So I think digital transformation in Indonesia has really just started, even though I'm sure many of you have been working in this for a number of years. I do think the size of the opportunity over the next 10 years is massive, and it's a very exciting time. So, like I said, it is difficult, but it is entirely possible. So please be brave and share the lessons learned as you go, because that's absolutely important. And hopefully we see the fruits of your labour over the next few years with new exciting customer experiences, products, and some fantastic digital banking coming to market. So I hope very much I see that.
Yeah, we really hope so. Ms. Katz.
So I suppose my final comments are that a really interesting stat that you should all probably know if you're not aware of it is more people resigned in March this year than they've ever resigned before. 6.5 million people resigned. We're in the midst of the Great Resignation. And a lot of that is to do with the fact that leaders are not focusing on the right thing. You know, the leaders need, and I mean leaders, whether you're leading 5 people or 50,000 people, your only job is to create the conditions in which humans thrive, where they are least change resistant, where they are most able to be able to speak up about the blockers, the barriers, the behaviors, the risks that could stand in the way of success. And technology is not, I think you've heard each of us saying this over today, technology is not a solution. Technology is an enabler. to get you to somewhere. So be really crystal clear about what your good looks like, what your future state looks like, and make absolutely sure everyone across your organization gets that, sees that, and can see progress towards it. And that's how digital transformation succeeds.
Thank you very much, Kat Skilly, for your closing statements, and also our speakers, Jeremy Larson, Nick Wild, and Dan Jones. Thank you very much for this session. Please give you a huge round of applause for all of our speakers and also our audiences. Once again, thank you very much, all the speakers. Yeah, distinguished guests, ladies and gentlemen, we would like to inform you that OJK Institute has launched the mini site of OJK Institute that will provide access to various information regarding the financial services sector, such as capacity building, professional certification institution, and innovative and visionary research. For details, you may visit link at www.ojk.go.id/ojk-institute, or you may scan barcode on the Zoom screen to access the mini site of OJK Institute. Next, we can inform that we have shared a link feedback form in chat features, and please fill it before the August 5th, Friday. As the requirements to get e-certificate, you may also access today's materials through the link that have been shared by us through the chat column and OJK Institute mini site on Friday, 5th August 2022. The materials and recordings at the OJK Institute mini site can be opened in the capacity building menu, then choosing the how to measure successful digital financial services return on digital investment webinar. Then the materials will appear on that page. And we would like to inform you that total audiences or participants at today's event is 2,872 people attended this webinar with the compositions of OJK at 11.56%, government agencies at 7.28%, and academician 6.51%, others 8.50%, and the banking sector at 41.99%, and the capital market 5.99%, and non-bank financial sector 17.69%. Distinguished guests, ladies and gentlemen, OJK Institute would like to invite you to Digital Governance Preconditions to Support Digital Transformation webinar on 11 August at 9 to 12 Jakarta time, which will be attended and opened by Chairman of the Audit Board, concurrently member of the Board of Commissioners of the Financial Services Authority, OJK, Ms. Sofia Isabella Watimena, with the speakers, our Professor Dr. Ilya Avianti, Bapak Syahraki Syahrir, and Bapak Ahmad Solihin Lutfianto. Furthermore, we would like to remind you again that OJK Institute will have a call for papers charisma activity OJK Institute 2022. Recover together, recover stronger through green economy, with the themes building an industry based on a green technology and implementation of sustainable finance in the Sharia financial services industry, with the final registration on August 15, 2022. Next, reading become easier anytime, anywhere through OJK e-library. So, ladies and gentlemen, and also insan OJK who like to read, you can use the OJK Digital Library or e-library through the link elibrary.ojk.go.id. E-library provides various types of books that can be accessed by OJK internal and external. OJK internal can directly access e-library by login using Office email and password, while for the external, you might first register your account through the register menu. Ladies and gentlemen, distinguished guests, we have come to the end of this How to Measure Successful Digital Financial Services Return on Digital Investment webinar. On behalf of Indonesia Financial Services Authority, I would like to thank you for joining us on today's event. We are looking forward to meet you again in the near future. Wabillahi taufiq wal hidayah. Wassalamualaikum warahmatullahi wabarakatuh. I'm Aldi Hawari. Sampai jumpa.
Thank you, Jeremy. Thank you, Nick. And thank you, Dan.
Thank you, everyone.
Terima kasih, Pak Sarbuan. Thank you, gentlemen.
Thank you. It was a great pleasure.
Terima kasih, Mbak Vita dan kawan-kawan juga ya. Thank you, gentlemen.
Thank you, everyone.
Thank you very much.
Thank
See
you,
you
Kat
next time.
Kelly. Thank you, Kat Kelly.
You are more than welcome. It's been a real pleasure. It's been really interesting. Thank you for being here.
Thank you.